Welcome to the European market open. A minute to go until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. Europe grapples with its worsening winter COVID outbreak. Germany pushes for more people to get vaccinated as Belgium reimposes work-from-home mandates. Wall Street punishes retailers that don't pass price increases on to consumers as investors debate central bank's next move. China Tech leads losses in Asia with Alibaba due to report. And more top interviews from the NEF in Singapore. We'll bring you more from our conversations with HSBC CEO Noel Quinn and Microsoft founder Bill Gates. Okay, let's check in on the futures. European markets managed to post gains of about 0.1% yesterday. The FTSE ended in the red. The futures in the US currently pointing up to close to 0.2%. The Spanish IBEX is opening lower by about 0.2. The UK FTSE 100 is also lower as well. So for the moment, the first few seconds building on the losses. Don't forget the basic resources will be in focus given that iron ore is down between 2 and 3% again. You also had European car registrations falling in the month of October by almost 30%. You also have to bear in mind that Citi as well has joined the likes of Morgan Stanley to bet that the rate hike cycle is going to be more aggressive and faster than the markets are currently pricing in. That is another factor that paid through into the markets in the US as well. France and the CAC 40 is flat. Let's have a look at some of the cross assets that we're keeping an eye on. I wanted to bring your attention to the technology story in Asia. We flagged the preview of Alibaba, but Chinese tech stocks are being hit. Poor earnings from the likes of Baidu and Bilibili weighing on this sector, down more than 3%, and that is dragging the Asian equity space lower. You did have a bit of upside for Japanese equities on the back of some stimulus news, then they came off in terms of the Nikkei. Brent is in focus again on the back of reports that maybe the US and China are continuing discussions about releases of reserves, down more than 1% below $80 a barrel. Euro dollar is stronger by 0.1%. That's on the back of softer dollar, by the way. And the sterling is also gaining 0.2%. Again, the softness of the dollar is playing into that. Let's have a look at how things are breaking down on a sector-by-sector basis. Yields have come off a bit, so financials are slightly lower. Industrials, mixed, but slightly to the upside. You're seeing green on the screen for staples. And in terms of healthcare, that is low. We'll talk to Yogi Dhawan about that in a moment, because I know he's bullish on healthcare, so get his views from Hassam Asset Management, though he says that range bound is what we're looking at in terms of the equity markets in the months ahead. So that's a picture of the sector breakdown. We'll get to the movers later. We were going to look at the likes of Continental, Nokia as well. Cisco under pressure after hours on the back of the fact it's seeing strong demand, but the components, that lack of components, means that it's missing out on getting those products to its consumers. Okay, European equity markets then opening mixed at the stage. We do have the individual stocks to watch now. Continental, we're talking about the fact that the CFO has been ousted as the investigation into the diesel fixing scam around VW continues. A major supplier, of course, to that car company. Metro Bank, currently unchanged, which is a surprise given that they broke enough talks with Carlyle Group. You can see now Continental down more than 5%. We're getting there slowly. The data is feeding through. Nokia down 0.3%. OPE, European equity markets, we just run through that. We saw losses, of course, in Asia. We've talked about why. The US as well. Investors grappling with the risk that central banks may taper asset purchases and hike rates faster than expected to counter price pressures. CEOs from Bloomberg New Economy Forum, they've been speaking. They've weighed in, of course, on the inflation debate. Take a listen.
today we don't provide most of our signed-in services in China, and I don't see that changing. But there are ways, as I said, in areas like AI or sustainability, I think there'll be opportunities for us to work together.
There's either pressure or directive for us to do certain things differently. Sure, there's a possibility. But we think about this with a 10, 20, 30-year perspective, not with next couple of year perspective. And so we're long-term committed.
I think they need to both take a little more time to better understand each other. There's some disconnects right now. I think Biden is trying to engage more, but there's still some disconnects.
We all acknowledge that there are differences, but differences get resolved through dialogue. And it's great that China and the US were talking. I don't think the world can decouple from one of the biggest manufacturing nations of the world and what will be one of the biggest consumption markets in the world. So I really hope it doesn't decouple.
Okay, joining me now to discuss the markets and all the action at the New Economy Forum is Mark Cudmore, Bloomberg Markets anchor in Singapore. Mark, what are the top things that are really front and center for you? The inflation debate, questions about food prices. There's pressure in the oil space at the moment. The China-US relationship continues to be discussed. What is standing out for you?
I think from the New Economy Forum, it is those two big themes. It is the idea that we're very, very focused on the US-China relationship, and the mood music there is generally a little bit positive. Nothing concrete, but it's kind of this idea that, look, it's moving better than it was a year ago, but people are very, very nervous and focused on it. And of course, inflation is very much front and center in everyone's minds. I thought some of the topics around food inflation in particular were really, really relevant, because I think that will be the big kind of crisis that comes in next year. And of course, food inflation plays into every single factor we're talking about in markets at the moment. It's climate. It is the energy crisis, which makes it expensive for fertilizers, means we're turning off industrial greenhouses. It's the supply chain issue in delivering food around the world. And it's the problem about labor shortages in a lot of food industries. So I think food inflation is the big concern, and that really came through in some of the discussions here.
Mark, what is your take then of this move by Citi aligning with Morgan Stanley to price in a higher rate hike cycle, a more aggressive, a faster rate hike cycle from the Fed?
Look, I have a lot of sympathy for this idea, because to me, it's a little bit of a binary outcome next year. Either we're going to kind of get beyond the inflation scare early in the year, and we're going to be back into rates are never moving higher anymore again, in which case you've got a small bit of downside. Or there's a chance that the Fed is really behind the curve. Supply side inflation transitions into demand-led inflation, and the Fed needs to hike super aggressively, and talk about 2 or 3 hikes next year are irrelevant. It might have to be doing 6, 7 hikes. It might have to be raising 200 basis points over the next year or so. So I think there's a risk reward in that trade. However, my one qualifier is I'm not sure this is the time to do it. We've just had the inflation print. I think there's a chance the next couple of weeks could see a little bit of subsiding that inflation pressure. I think it's maybe more of a trade for first quarter next year, when rates come down a little bit, then to play that risk reward.
Mark, I know you've been across the commodity markets as well for weeks, months. In terms of iron ore, I'm seeing it down again 3%, it's down almost 60% since May. Oil, of course, under pressure. What are you making of the moves in the commodities markets at this point?
Well, for iron ore, I always listen to our colleague Jake Lloyd-Smith, who's a bit of a soothsayer when it comes to the iron ore market, and he is continuously bearish. He's just saying there's endless supply there, there's a lack of demand, it's basically a perfect storm against iron ore. But iron ore, it is an ore, it's less about kind of the industrial metals. I think in the industrial metals, we do have this intense backwardation across the market. The medium story is still very strong. The whole greening of economies, the drive for climate issues, means that there's a big tailwind for copper that's going to last for years. Copper and some other metals, as we kind of electrify many kind of parts of the market, many industrial processes. So I think that generally the medium-term picture for metals is good. Very short-term, I have no clue in the next few days.
Okay, Mark Cudmore, Bloomberg Markets anchor in Singapore, across all of the major topics that have been discussed at the New Economy Forum. Just a breaking line to bring to your attention now. Germany's N26 bank, this is the digital bank, will exit the US market and close 500,000 accounts. This was a bank that was recently valued at about $9 billion US. So they're discontinuing their US operations. We'll get more. If we get more, we will bring that to your attention. By the way, Metro Bank, and this was one of our stocks to watch, falling 20% after those talks with Carlyle came to an end. Okay, coming up, we've been talking of banks, to HSBC CEO Noel Quinn at the Bloomberg New Economy Forum in Singapore. We're going to get his views on the global recovery, inflation, of course, China. This is Bloomberg.
An extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Welcome back to the Open. We are 11 minutes into the European trading day. You're flat across the benchmark. Stocks Europe 600 lower by 0.3% here in the UK. FTSE 100 dragged lower by the miners. Basic resources. The futures in the US pointing to gains of 0.2% after the sell-off yesterday. Okay, now, the strength of the global economy has been a key theme on the second day of the Bloomberg New Economy Forum. Earlier, we spoke exclusively with HSBC CEO Noel Quinn and got his views into US-China relations and, of course, the inflation debate.
The world's economy is recovering. It's recovering well. There are tensions in the supply chain. We shouldn't be too surprised by that. We went into fast reverse. We're now going fast forward. There will be friction in the supply chain for a period of time. But take it as a positive that the world is recovering and economies are rebounding. If I then look at the concerns for the future, I am concerned about inflation, because I think at the same time as the supply chain recovering, there are some new issues. Supply chains are repositioning, partly because of geopolitics, partly because of resilience considerations by governments. Oil prices are going to remain high for quite a while because there's constrained supply. And the investment cost of new sustainable infrastructure is going to have a premium in the near term.
But do you worry about shocks, or do you worry about monetary mishap? What does it mean for a big bank?
I think controlling inflation is going to be a fine art as opposed to a science. And I think we're going to have to make careful judgment calls in the central banks over the next few weeks and months as to how they keep the balance between economic recovery and making sure inflation doesn't get out of control. And I think they'll do that through pulling back on QE and progressive, gradual increases in interest rates. And I think countries will move at different times on that, and that's okay. But it's going to be about balance.
We just heard from the former Treasury Secretary, Hank Paulson, also saying it's almost impossible for the U.S. and China to decouple.
Yeah.
Like, how do you read the Chinese economy right now, and has HSBC rebuilt ties with them?
Well, listen, the Chinese economy has been big as a manufacturer of the world for many decades. It's also huge as a consumption market for the future. And I don't think the world can decouple from one of the biggest manufacturing nations of the world and what will be one of the biggest consumption markets in the world. So I really hope it doesn't decouple. Will there be differences? Differences in views on technology, differences in views on politics, yes. But I think it's important that there is a level of connectivity between the world and Asia and between the US and China.
In general, for your wealth business, do you see, how many bumps along the road do you see? Do you see like a clean trajectory upwards in terms of how you build and
For
grow?
us, it's continuous investment. We already start with a very strong platform in Hong Kong. We're one of the biggest wealth managers in Hong Kong. We have on our balance sheet over 1.6 trillion of assets under management, wealth assets under management for our clients, whether it's in private banking, asset management, it's in our retail operations. Now, for me, it's about a continuous investment program. I guided the market that we were going to spend $6 billion over the next 3 to 5 years. $3.5 billion of that is building out our wealth business within Asia. And we're going to do that across all of Asia. I think there's wealth opportunities in Hong Kong still. China, definitely. Singapore, absolutely. And also India. Now, that will be a combination of organic investment, recruiting people. And as you've seen in Singapore, we bought a business, or are in the process of buying a business from AXA. Bring that business together with our insurance business, and we have a much more powerful wealth proposition here in Singapore. And I'm looking at 3 or 4 other opportunities like that as bolt-on acquisitions over the next few months across Asia.
Noel, have you spoken to Hong Kong authorities so that you don't have to do a quarantine next time you come back, as they rolled out the red carpet for...
I'm not planning a trip at the moment. I think it's important for Hong Kong to establish what they need to establish with China on reopening the Hong Kong-China border. I don't want to do anything that may jeopardize that. I would love to get back to Hong Kong as soon as I can, and when the authorities feel it's right for me to go back, I will do.
That was HSBC's Group CEO, Noel Quinn, speaking exclusively with Bloomberg's Francine Lacroix in Singapore, saying controlling inflation is going to be, quote, a fine art as opposed to a science. Just recapping one of the big stock movers of the day, down 20%, Metro Bank on the back of the news that the discussions it was having with Carlyle from November the 4th, that they have been terminated. Worth pointing out as well that the bank's bonds have fallen to their lowest price since November the 3rd. You've got a couple of sector drags on the FTSE 100. One is basic resources, but the other is financials, and Metro is playing into that. So the end of the talks for Metro Bank, JP Morgan, one of their analysts, said that the restructuring and recapitalization of that bank would be significant. They don't see it turning a profit until 2025. So we'll see what happens with this bank. Pressure on those shares. Very significant sell-off, of course. Okay, let's get into the inflation conversation in more detail then, the key drivers in markets. Joining us on set, I'm very pleased to say, is Yogi Dewan, CEO at Hassiam Asset Management. Yogi, we saw overnight US Citi joining Morgan Stanley in increasing their base on euro-dollar in terms of where they see the rate hike cycle. Do you think markets are underestimating the pace, the aggressiveness with which the Fed will be compelled to raise rates once taper comes to an end, middle of next year?
You know, Tom, the first rate hike is expected in July.
Yeah.
And then another rate hike in December. And that's actually already increased. The sentiment around rate hikes has increased. It's hard to see rate hikes aggressively taking place sooner than is currently priced in with where GDP actually is. And the issue you've got is the backwind of all the issues around supply side constraints, what the implications will be for tapering, whether inflation will actually moderate. There's just too many moving parts for something to happen so aggressively.
We heard from Goldman Sachs' CEO, Solomon, yesterday saying that greed is now outpacing fear in the markets. Is that your interpretation? Are you seeing the same features at play?
I wouldn't say it was greed, but I would say momentum is at an all-time high. You just have to look at what's been going on over the last 2, 3, 4, 6 weeks. You've got RSIs up at 65 to 70 across the board in Europe, in the US, globally. Momentum is really, really high, but we've had a really strong earnings season, Tom. You know, we've got earnings growth of, 17%. We've got revenue growth of 17%, earnings growth of 39%.
But what about the sustainability of that earnings growth? Did that take us, can that support the markets along with negative real yields? Are those the supporting factors that we're looking to for 2022 that keeps this market in these kind of ranges?
Yeah, it's earnings that drive share price appreciation, but it's hard to see the earnings momentum maintained in the current environment. If you look at what calendar year 2021 is expecting, we're talking about revenue growth of around 15%. We're talking about earnings growth of 43%. That's just not likely in the current environment, bearing in mind the narrative that's now coming out with supply side issues and inflation. Certain sectors are going to do well in this environment. Obviously, the energy sector, oil being one of them, but broad-based energy. Financials should do well once the rate hike cycle actually starts. But the rest of the market is really struggling, particularly tech sector, particularly with valuation risk as high as it actually is. And we've become more defensive in the way we've allocated to equities and risk.
We're seeing some of these policy changes in countries like Belgium around COVID. We're seeing record cases in Germany, ICU units in some parts of the US are now at maximum capacity. Do you think investors are underestimating the COVID risks, that there is that fatigue now? Is this another risk that we should be weighing up?
It's definitely another risk in terms of Delta Plus, but there's a lot of advancements in this space, and the market is very used to managing the impact of what COVID has done from an economic perspective. Just look at unemployment rates. They're back up, doing much better. Look at GDP growth figures. They've actually improved in quite a meaningful way. The issue around stagflation is no longer really on the table because the environment's looking a lot better. We're learning how to navigate through a very, very difficult marketplace at the moment.
Yeah, some of the developments in the healthcare space around treatments as well are positive, obviously. Yogi, thank you. You're going to stay with us. I'm very pleased to say Yogi Dewan, CEO of Hasim Asset Management, will get some of his calls on China, Bitcoin as well. Okay, coming up, Walmart and Target shares sell off as the US retailers pledge not to pass price increases on to consumers. We've got that story. This is Bloomberg.
Reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Welcome back to the Open. We are 23 minutes into the European trading day. Some very, very marginal gains across the European stocks benchmark 600. US futures putting up 0.2%. Basic resources, energy prices, those sectors are both under pressure. Travel and leisure at the top when it comes to a sector-by-sector basis. Despite strong earnings from Walmart and Target, investors are selling off shares after US retailers pledged not to pass price increases on to consumers. The sell-off reflects investor unease over supply chain bottlenecks, rising fuel costs, and the highest inflation in 3 decades. Let's bring back in then Yogi Duan, CEO of Hassiem Asset Management, on this story. So if the Walmarts, the Targets of the world, they pass prices on, if they were to do that to consumers, they're concerned that they might lose market share, that consumers might bulk at higher prices, so they're eating up the costs. But the markets are punishing them for that. Does this point to further diversification, divergence within the equity markets? Those parts of the equity markets where prices can be absorbed or can be passed on, I should say, and you saw that from some of the big conglomerates around white goods producers and things, and then the retailers who are sucking it up. How does this play into your view of the markets when it comes to corporates and retailers?
We would love to invest in companies that can soak up the cost and not pass it on to consumers. And we go back to the equation, you know, if you look at how companies should perform from an earnings perspective, it's revenues minus cost. And we're more concerned on the revenue number. We want to see a revenue number that is consistent going into next year and following years. And earnings can be manipulated in the short term, as you and I both know, and the market knows only too well. So it's a really interesting dynamic when you look at the retailers. There's obviously an increase in consumer demand. There's obviously an increase in inventory demand, but the issue is supply-side constraints, which impacts on pricing and some inflation, and they must not pass that on to the consumer. If they can avoid passing that on to the consumer, they will maintain their revenue number, and that's what the market wants to see.
Okay, that's the focus for you then. I know you've increased exposure to areas, sectors like healthcare, infrastructure, ESG. Just unpack that call for us.
Yeah, sure. We're looking at a market that is very overvalued on a PE basis. In the US, we've got forward PEs at 22. Even in Europe, we've got forward PEs at around 17. From our perspective, we want to be more defensive in this market, bearing in mind valuation risk, bearing in mind growth risk. And from that perspective, we like to go for more defensive names. So we focused on healthcare, we focused on infrastructure because it's a play against inflation. And we're also looking at ESG and impact investing. We've also even looked at the fixed income markets as well and started to focus on China and Chinese sovereign debt as well.
You're still overweight China? We
are still overweight China. Look, China's only up 4% year to date, but here's the interesting figure for the longer term. If you look at the MSCI World ACWI, it only has a 4% holding versus the US at 55%. There is huge margin for investment into China over the medium to long term. And remember, this is a $15 trillion economy. Japan is only 5, Germany is only 4, the UK is only 3 trillion. There will be significant inflows into China over the medium to long term. And remember, we're long-term investors. We are not traders, we are not speculators.
Okay, Yogi, we appreciate your insights. Thank you for coming on set with us, sharing those thoughts, long-term constructive on China. By the way, he has a Bitcoin call of 52,000, another leg lower for the cryptocurrency, according to Yogi Dowan, CEO of Hassiem Asset Management. Okay, coming up, some European countries put restrictions on the unvaccinated as COVID cases surge across the continent. That story is next. The Stocks Europe 600 gaining very marginal. The US futures are up 0.2%. FTSE 100 down 0.2. This is Bloomberg.
there's a pretty good chance that you use products made by Meta every single day. If you've never heard of Meta, that's because it's the new name for Facebook Inc., the parent company of Facebook, Instagram, and WhatsApp.
All right, perfect.
In a spiffy presentation on Thursday, Mark Zuckerberg showed off his vision for what he's dubbing the metaverse. That's a sort of mix of augmented and virtual reality worlds which will let the user explore virtual ecosystems. Much of what he showed isn't yet available. It's really his vision. In that sense, it was more like the sort of presentation Elon Musk does, where he looks at what he hopes might happen one day, than what Steve Jobs does, or Steve Jobs did, which is showing off products he already has available. He also, in the course of it, announced a name to Meta. The company will be called Meta from now on.
Our mission remains the same. It's still about bringing people together.
That's an effort partly to show the vision for the future, but also a way of casting adrift some of the toxicity associated with Facebook. But if this new company is going to be a success, or the new company vision is going to be a success, he will still have to deal with a lot of the same challenges that Facebook has faced. Concerns about privacy, content management, those are going to be just as pertinent, if not more so, in the metaverse as they are right now on Facebook's existing apps.
From New York City.
In London, in Sydney.
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open. We are 30 minutes into the European trading day, and here are your top stories. Europe grapples with its worsening winter COVID outbreak. Germany pushes for more people to get vaccinated as Belgium reimposes work-from-home mandates. Wall Street punishes retailers that don't pass price increases on to consumers as investors debate central banks' next move. And Amazon takes the Visa feud across the Atlantic. After its UK card ban, the retail giant is now considering shifting its popular credit card to MasterCard in the US. So we are seeing gains in the European markets of 0.1%, building on the gains of almost 0.2 that you saw yesterday, and looking past the modest sell-off that you saw in the US, but also in Asia as well. Asia dragged down by Chinese tech stocks. The Nikkei bumped a little bit on the back of stimulus plans, then it ended slightly lower. In terms of the European stock 600, gaining 0.1%. It's a better picture in Germany, gains of 0.2%, 32 points. The FTSE 100 is lower. Basic resources, energy, are dragged there. Certainly iron ore prices are lower. Oil, WTI and Brent, both below $80 a barrel. That is the index look. Let's have a look then at sector by sector. I talked about basic resources and energy. Financials also in focus. Metro Bank ending those talks with Carlyle Group. And of course, the yield story will remain in focus, still currently below 1.6%. So financials will be feeling that as well. At the bottom of the list, you've got energy down 1.2%. At the top of the list, you've got travel and leisure, followed by autos. Interesting that those auto numbers in terms of registrations for the month of October falling almost 30%. So that is a sector look, 30 minutes into the trading day here in Europe. Let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. Many European governments are adding new restrictions on the unvaccinated as they battle a new wave of COVID infections. Germany reported 50,000 cases in a single day and is limiting workplace access to people who are vaccinated, recovered, or provide a negative test. Belgium is reinstating work from home 4 days a week, despite opposition from some business groups. The ECB's vice president says inflation should slow next year, but not as quickly as expected a few months ago. Luis de Guindos told Bloomberg that easing price pressures would prove the current bout of inflation is transitory. He also says he does not expect the ECB to raise rates for at least a year.
We will see what happens over the next months with the evolution of the economy, the evolution of inflation. But my personal view is that it's going to be quite unlikely to have a lift off of rates in 2022.
Boris Johnson is said to have told a private gathering of Conservative lawmakers that he'd driven the car into a ditch after 2 weeks of negative news stories for his party. Shortly after the meeting, the House of Commons voted to adopt the UK Prime Minister's plan to tighten the rules on second jobs for politicians. Opposition parties abstained the vote, calling for tougher reforms. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Laura, thank you. Okay, as COVID cases surge across Europe, some countries are introducing targeted measures against the unvaccinated. Austria has taken the hardest line yet, putting its unvaccinated population under a 10-day nationwide lockdown. Sam Fazeli from Bloomberg Intelligence joins me now. Sam, give us a read of what's happening across Europe then. There's a divergence between the northern part of the continent and the southern part. Why is that breakdown happening, and what is the policy response so far?
Yeah, absolutely. So, and when you look at countries such as Portugal and Spain, and perhaps Italy even, although every country, I think, is seeing a rising number of cases as the winter sets in, you're seeing a much lower, they started lower and a much lower level of rise in those southern countries, which to a degree, I think, has still got to do with that impact of the winter that we're seeing that drives people into indoors and makes them more vulnerable to be transmitting the virus. And then aside from that, you have a major difference in vaccination rates. Now, we do know that vaccinated people can still get infected and pass it on. So that's a mild benefit, but I think the temperature element and also possibly the population level and the density of population, all of those are playing into driving a difference between the colder northern states and the slightly warmer southern states.
Okay, and in terms of the measures being put in place by governments around the Eurozone to tackle this, we've talked about Austria, of course, and the lockdown for the unvaccinated. What other measures are being drawn up or being put into place?
Yeah, so, some of the things that I've been hearing, which of course is what they've done in Austria, for example, is to limit the mobility of the unvaccinated. I think the way they're going about it is probably not the most effective way, perhaps, because it really creates a them and us situation. I think if you were going to do something to incentivize people to get vaccinated, which is what they need to do in Austria, given the rate of vaccinations they have, perhaps having gone down the route of what France did, which basically put in rules saying, if you want to partake in society broadly, entertainment, restaurants, enclosed areas where the public are gathering, you need to show proof of vaccination. That perhaps would have been a better way of doing it, but I don't run these countries. Austria has taken this way. There is a slight rise in the number of vaccinations based on the Bloomberg vaccine tracker. So if it works, perhaps it's a price well worth paying.
Yeah, and those measures, though very controversial in France, did prove effective in boosting the vaccination rate, didn't they? In terms of the boosters, Sam, how effective, do we have clarity from data as to how effective these boosters are and will prove to be?
Yeah. So whoever is a big fan of champagne here should get ready to pop it because it's showing an immense effect, a significant effect on the number of cases. However, that's data from the UK and which backs the data that we've already seen from Israel. But I think what we really want is the day that I would celebrate is if I see that continue well into the 5th and 6th and 7th month. The question being, can we hopefully at worst end up in a situation where we just need an annual booster to try and keep the infections under control? And that would be the day that I would really crack out the champagne.
Okay, so ready the champagne. That duration, though, of the boosters in terms of how much they can sustain, how long they can sustain holding off this virus for, will be in focus. Sam Fazeli from Bloomberg Intelligence, thank you for those insights. Okay, it is the second day of the New Economy Forum in Singapore, and COVID-19 remains a topic there. It remains a topic of concern, of course, as flare-ups around the world continue to impact lives, as we just discussed, and hamper economies. Bill Gates, founder of Microsoft and co-chair of the Bill and Melinda Gates Foundation, told us COVID may get to flu-like levels by mid-2022.
Well, the vaccines are very good news, and the supply constraints will be largely solved as we get out into the middle of next year. And so we'll be limited by the logistics and the demand. In a lot of countries, it's not clear what the demand level will be. Ironically, in a country like many in sub-Saharan Africa, where the epidemic hasn't been as visible, your demand for the vaccine, it's challenging to generate that, but we'll do the best we can on that. The other thing that's pretty impressive is that, you know, Merck and now Pfizer have oral antivirals that the Merck drug, we've been able to reformulate to get it to be less than $8. And so we'll be able to have anyone whose age or medical condition makes them have significant risk immediately begin what's called presumptive treatment as soon as they test positive. So between natural immunity, vaccine immunity, and these oral treatments that can scale up in a way that the antibodies never did, you know, the death rate and the severe disease rates ought to be coming down pretty dramatically. And, you know, by next summer, getting to be, say, quite a bit lower than the average seasonal flu level is, assuming there's no surprise variants, which right now the evidence is that's not that likely, but it can never be ruled out.
What do you think, you just mentioned next summer, what do you think victory looks like in this? Is it effectively taking COVID back? You also mentioned the flu. Is it effectively making COVID a kind of flu-like disease? I know it is, but is that the kind of version of what victory is in your brain?
Yeah, things are fairly binary. I mean, if, you know, death rates from driving were 10 times what they are, people might think, wow, shall we do it or not? You know, flu is accepted. The, you know, average years of life lost for both flu and COVID is about 8 years because it's so prevalent in the elder versus the young. And we accept about a 60,000 average per year right there. Now, I happen to think as part of the tools innovation to avoid the next pandemic, we ought to go and eradicate flu as well, because its mutations are another source of a significant source of future pandemic risk. But yes, the idea that economic activity will resume in full once you get to flu levels, it's very likely. Now, you'll have some hot spots where you'll still have to have non-pharmaceutical interventions or, you know, huge incentives for people to get protected.
In Europe skid to their worst October in recent records. We'll get into what's putting the brakes on the continent's auto industry next. This is Bloomberg.
Common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector. In Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open. We are 44 minutes into the European trading day. European stocks just clinging on to gains then of about 0.1%. The futures in the US are looking up 0.2%. Top sector here in Europe currently is autos, gaining 0.7%. Bottom of the list, you're looking at energy, followed by basic resources. Let's check in on some of the individual movers then. We've been talking about Metro Bank, the fact that they've broken off talks with Carlyle, and that stock taking an absolute hammering on the back of that news, down almost 20%. So they're broken off those talks. They started on November the 4th. Those have now officially come to an end. JP Morgan had talked about the need for restructuring and recapitalization of this bank. Continental as well, the CFO ousted amid continuing investigations into the VW diesel scandal. Continental, a major supplier to that company, down almost 3%. Royal Mail, though, very different picture. They've reported earnings, but the top line, and this is what's powering the stock higher, almost 6%, 5.8% currently, is that they're going to be handing investors back $540 million in terms of shares. And that is part of what is happening in terms of the earnings out of Royal Mail. That is the surprise, $540 million. They have done better in terms of deliveries. So they're going to be returning £400 million, $540 million to shareholders. So they are looking positive in terms of online sales, and that is pushing share prices higher for Royal Mail. Okay, let's switch focus to the auto sector. It's another speed bump for car sales, despite the fact that, by the way, the sector is doing pretty well today, dropping to their worst for October in recent records. That is car registrations across the Eurozone. Manufacturers see signs that the protracted chip shortage that has idled production is finally easing. Joining us now is Elizabeth Berman, who runs our European autos coverage. Elizabeth, what is the state of affairs then now, currently, around chip shortages within the auto sector?
Yes, after the third quarter, which was pretty much the worst we'd seen in terms of the shortages, there are now finally signs things are slowly getting back on track. That said, though, car makers still expect the remaining few weeks for the year to be fairly tough, and the chip crisis to stretch well into the next year too. Among the positive signs that we've picked up as well are some of the chip makers like Qualcomm saying that they see the situation improving by using, for example, multiple suppliers for their chips. So finally, things look to be getting back on track.
Elizabeth, is there a risk that the automakers can be blaming or are blaming the supply crunch around semiconductors for what actually could be softening demand, or is this a genuine impact? Is this the primary driver of the concerns?
It's the primary driver of the concerns, though. I do realize that if you look at where deliveries have been heading, also at the individual company level, at Daimler sales during the third quarter and also this month, down by a third, Volkswagen down by 42% in October. But across the car makers, they've really been able to offset this crisis by really focusing on making the most lucrative cars. So while sales are down, earnings profit has really held up very well.
Okay, and the transition, of course, is well underway in terms of that shift towards EVs. How are EV sales holding up amid the chip crisis, and what does that tell us about forward-looking demand?
Yeah, finally, EV sales have taken off this year, as we know, and in Europe's 5 biggest markets, they make up more than a fifth of sales now. That's plug-in hybrids as well as battery electric cars, and they have been less affected by compared to some of the other models, the combustion models, from the chip crisis. But even there, we've seen some of the exponential growth in EV demand that's been flattening as well, because of course, as the chip crisis grew ever worse, there were some impacts there as well.
Okay, yeah, certainly not immune from these supply chain constraints. Bloomberg's European Autos editor, Elizabeth Berman, thank you for the latest on that then. Let's get the Bloomberg Business Flash with Laura right now. Laura.
Thanks, Tom. India's largest digital payments provider has lost more than a quarter of its market value in its first day of trading, heading for one of the worst ever debuts by a major tech company. The 26% plunge in 197 Communications, operator of Paytm, surprised even some skeptics who had questioned the company's valuation. The offer was India's biggest ever IPO. Amazon is said to be considering shifting its popular co-branded US credit card to MasterCard amid simmering tensions with Visa. The feud has already prompted the retailer to ban Visa credit cards in the UK starting next year. Amazon is unhappy that despite technical advances, some companies' payments fees continue to stay high. Cisco has given a lackluster revenue forecast for the current period, blaming supply chain issues from component shortages. The world's biggest maker of computer networking equipment says it's expecting sales to increase by a maximum of 6.5%, half a percentage point below forecasts. Cisco is trying to reduce its reliance on hardware sales and boost offerings of software and internet services instead. NVIDIA has given an upbeat fourth quarter forecast fueled by its expansion into data center chips and other markets. The chip giant expects revenue to hit $7.4 billion during the period, more than $500 million above estimates. NVIDIA has averaged around 57% revenue growth over the last 8 quarters, pushing its market cap way beyond Intel's. That's the Bloomberg Business Flash. Tom.
Laura, thank you very much indeed. Okay, coming up, Goldman Sachs boosts its bet on London. The US bank targets the world's super rich. More on that next. This is Bloomberg.
represent 5,500 forecourts, which is roughly 65% of all service stations in the UK. Of the ones that we were able to survey yesterday, roughly 1,500, 27% said they didn't have any fuel, 21% said that they had one fuel type or another, so that's either petrol or diesel, and 52% said that they were fully stocked. Northern Ireland, Wales, Scotland seems to be okay, so we still are seeing, like your reporters are seeing, some stockouts at sites around London and the South East, I'm afraid.
When do you feel confident that this will 100% be in the rearview mirror?
Well, what we're hoping is those people that got fuel over the last few days obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks, to get it back to the sort of more normal running levels.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 53 minutes into the European trading day. Just clinging on to gains across the European markets. Year to date, you're up 22%. The FTSE 100 is lower by 0.2. Basic resources and energy are dragged there. The DAX and the CAC Cajon are higher. Your futures in the US pointing to gains. Okay, the second day of the Bloomberg New Economy Forum is underway. We're going to bring you some of the top conversations from the day. There's already been some fascinating insights onto topics around inflation, US-China relations, of course, and the outlook for some of these corporates. Also today, the European Business Summit. The focus in Brussels will be on increasing digitization and the shift towards sustainability. And at 11 a.m. UK time, we're going to get a rate decision from Turkey's central bank. That comes in the wake of the country's slumping currency. Of course, we heard from Erdogan yesterday as well, talking about the need for lower rates, still further lower rates. Finally, the IMF Statistical Forum is happening in Washington, D.C. for all you stats geeks. That's at 2 p.m. UK time. The theme is measuring the economic and financial dimensions of climate change. Okay, we're going to be talking about Goldman Sachs, the fact that they're building out their footprint here to target the super wealthy. Before I do that, let's just check back on these markets. There have been some interesting corporate stories that we can bring to your attention at some point as well. We've been flagging these, the likes of Metro and Royal Mail, but let's just get you across what's happening across the Stocks Europe 600. Flats, building on those gains, 22% year-to-date upside, and you've just seen this gradual glide higher for European stocks over the last month. What is going to derail that? In terms of what happened over in the Asian session, Chinese tech took a really big hit on the back of disappointing earnings from Baidu and Bilibili. It was the softness around advertising that dragged on those shares, and there was a pretty brutal read-through. In terms of the Brent price, you're just clinging on to $80 for Brent. It was previously below $80. 35, 0.3%. That is where things are standing on speculation that maybe the US is going to put in place these reserves possibly alongside China, which would be pretty fascinating if that was coordinated. Now dipping below $80 a barrel. Euro dollar, you're seeing gains of 0.1%, currently 113. There's been pressure on the single currency. Metro Bank as well. Wanted to bring this to your attention, lower by almost 20%. Ending talks with Carlyle, the private equity firm, of course. Those talks, we've been flagged and heard about those on November the 4th. Those have now ended, and Metro Bank is selling off. Royal Mail, by the way, handing cash back to its investors, about £400 million. They're pretty optimistic in terms of deliveries as we head towards the holiday season. Let's check in on how things are playing out sector by sector. You've got to factor in then the lower oil prices, but also iron ore down between 2 and 3%. The continuing concerns about the demand in China, the world's second largest economy, as it wrestles with the real estate sector and the expectations that there will be lower demand for iron ore. Implications then for the UK, the FTSE 100, of course, but also implications for those major suppliers like Australia. We can take a look at GRR and the sectors. Travel and leisure are at the top of the list. Autos as well, despite the fact that those registrations in Europe fell by 30% for the month of October. Bottom of the list, you've got energy, not a big surprise given what's happening with WTI and Brent. Basic resources as well. Iron ore, the factor there, down almost 1%. There is plenty more coming up. Stay tuned. That is it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the quarter three was the quarter that was most affected.
People feel the pinch of inflation and cost increases when they go to the store, when they go shopping and the like.
Some of the capabilities the team has built over the last several years, to use the ports example, operating 24/7 in the ports, that's something we've been doing as a retailer for quite a while now.
The idea that economic activity will resume in full once you get to flu levels, it's very likely.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Yusuf Gameluddin in Dubai. Francine Lacqua will be joining shortly from the Bloomberg New Economy Forum in Singapore. Let's get you then a bit of a snapshot of what's coming up on today's show. Starting off with Europe, the continent is grappling with a worsening winter COVID outbreak. Germany pushes for more people to get vaccinated as Belgium reimposes work-from-home mandates. Amazon takes the Visa feud across the Atlantic after its UK card ban. The retail giant is now considering shifting its popular credit card to MasterCard in the US. And more top interviews from the New Economy Forum in Singapore. We're going to bring you more from our insightful conversations, from HSBC CEO Noel Quinn to the Microsoft founder Bill Gates. Well, in terms of the market action, we are in a situation where the market is looking for a footing and a little bit of direction here. This is the picture. The S&P 500 mini call just about 0.3% higher. The Asian trade, we had a little bit of a sell-off in tech stocks that weighed on sentiment, but that's just starting to shift in the last hour or so. US 10s at 158.03, largely range-bound. We had a monthly 20-year bond auction that drew lukewarm demand. Citi is joining Morgan Stanley in backing the bet on aggressive Fed hikes. They're recommending a June 22 to 25 euro-dollar steepener. They're saying that's where the next big profit is. New Zealand dollar. Quite a bit of upside here. Everything else in G10 FX is a slumber. That's why I'm taking you to this currency pair after the country's 2-year inflation expectations climbed to the highest level in a decade. That's reinforcing bets for even more rate hikes. And then Brent crude, one of the big themes of the day, again down $80 a barrel at the moment. China saying it might release some of its strategic reserves, add more barrels to this market. Also, an investigation potentially in the United States on illegal conduct in the oil market. Let's flip it around now and get to the European story in a bit more detail. Looking here at stocks that are looking for a little bit more direction, a little change then after we had a record high, 6 consecutive days of gains. The jump in COVID-19 cases, keeping risk appetite quite muted, falling commodities weighing on the sector. Energy and miners are falling the most. There are some idiosyncratic stories like Metro Bank shares that are dropping 20% after the Carlyle talks were terminated. But with all of this in mind, the CIO at UBS Global Wealth Management just put out a note, which I read before coming on the show, and he sees further upside for Eurozone stocks because, in his view, the new coronavirus-related lockdowns don't look unlikely. Eurozone equities remain one of their more preferred regions. Valuations look undemanding. Well, with that in mind, investors are grappling with the risk that central banks may taper asset purchases and hike rates more quickly than expected to counter the price pressures that we're seeing everywhere in the world. The CEOs from the Bloomberg New Economy Forum in Singapore weighed in on the inflation debate.
I think inflation is getting to be a lot more structural for 2 or 3. Happens is when you start seeing sticker prices of 6 and 7%, that starts building inflationary expectations. And once inflationary expectations get anchored, then you get into the spiral. So I don't think it's such a temporary phenomenon.
I am concerned about inflation because I think at the same time as the supply chain recovering, there are some new issues. Supply chains are repositioning, partly because of geopolitics, partly because of resilience considerations by governments. Oil prices are going to remain high for quite a while.
When I step back and I think about my 40-year career, there have been periods of time when greed has far outpaced fear. We were in one of those periods of time. Given that it feels like inflation's running above trend, chances are interest rates will move up. And if interest rates move up, that in and of itself will take some of the exuberance out of certain markets.
Joining me now to discuss all of this and much more is Mark Cudmore from Bloomberg Markets. He's an anchor and he joins us from Singapore. Mark, we're seeing Brent and WTI just taking another leg lower, Brent below the key $80 a barrel mark. I'm wondering to what extent, sustaining that kind of level or even lower levels could take the heat out of some of these CPI figures.
I think that's a great question, Youssef, because obviously this is providing a lot of relief for markets. We know that inflation is the big story, it's the big threat, and obviously that is primarily driven by commodity markets, and most recently the energy crisis, which is perhaps most intense in Europe. Now, we are seeing a little bit of relief in oil prices, mainly in yesterday's session, but it is feeding through today. Interesting enough, when China came out, at least that story came out saying China is considering also joining the US and releasing oil from their equivalent of the Strategic Petroleum Reserve, it didn't actually weigh on oil much further. We're pretty much unchanged since those levels, which kind of suggests to me that that story is largely priced. That relief that we're going to get from that any potential release from the Strategic Petroleum Reserve is probably mostly priced. It doesn't mean we won't get another knee-jerk move lower in the very, very short term if we get a headline, but I don't expect it can sustain. I think that overall we still have another bounce in this oil prices in the weeks ahead.
I was looking at one of the surveys from Bloomberg, and 21 forecasters looking at year-end targets for the S&P 500. Lowest number, 3,800. Highest number, 4,800. That is a spread of 26%, which is the biggest spread in about a decade. Where does the Markets Live team think we'll end up?
It's a great question. We're actually just about to do our year-end survey, running it out for clients in 2 weeks' time. I haven't polled the overall team. I think the general view from the team overall is that we still see some more upside in some global stock markets, but the value has gone from U.S. stocks. I mean, people might have said that for some time, but I think that certainly the risk-reward of being in U.S. stocks is much less appealing here. We know that there's stretched valuations. We know the Fed is in a very, very tough spot. There is an inflation problem. That's not new to anyone. What we are trying to work out is the central bank reactions function. And because there's so much uncertainty around that central bank's reaction function, I think U.S. stocks are going to be a more difficult play. We had a guest in one of the earlier shows talking about how the idea that Chinese stocks may come back in vogue, even though the crackdowns there are not over. The fact is the discount is in the price there. There's a more exciting growth story. There's more potential upside. So I think if you're going to talk about the S&P 500, we're not particularly positive. We're not overly bearish, but we kind of think that that's not the risk-reward play. It's not where you get excited. People say there is no alternative, TINA, for buying stocks. It no longer means you need to buy U.S. stocks. You can look elsewhere around the world.
I was looking at what the New Zealand dollar is up to, and it's pretty much the standout on the global markets map in the FX column. You look at the 1 month vol from the JP Morgan surveys, and these numbers reach about 8-month highs. It tells you a story of ruptures, of dislocations as a result of the inflation expectations rising and the rate hikes that come with it. Where do you expect to see more of that kind of repricing to take place in the next few days?
I think we have more upside in FX vol overall. So the story of the last few months has been the idea that rates vols return to markets. That's because finally rate hikes or policy moves at the front end are back in play. And this is exciting for macro traders. So we've got rates volatility. That's been the theme of the last few months. Amazingly, up until the last week, we've seen FX vol stay very quiet. That's starting to change. Now it's happening. Now that people know that, hey, this inflation, it's not transitory, or at least it's not transitory in the sense that people were thinking about it a little while ago. It may end in 6 months' time, but it's not coming down as soon as people wanted, which means central banks are going to have to react to some extent. That means we're starting to get the path through to FX vol. I still think there's more upside in that kind of theme of FX vol catching up with rates vol, and I think into year end, I think there's going to be overall volatility in the equity market as well. So I think this idea of a permanently slightly more elevated plane of volatility from what we had 6 months ago is definitely valid.
Mark, thanks for that. I mean, I'm getting tired of this whole discussion around transitory. I just paid 4 times the regular price for an Uber here in Dubai. I mean, if anything, that is the story of the front lines of inflation. Mark Cudmore there, the Bloomberg Markets anchor from Singapore. Here's what's still to come on the program. More from the Bloomberg New Economy Forum. We've been speaking to the HSBC CEO, Noel Quinn, and we will get his views on the global recovery, inflation, and China. My colleague Francine Lacroix has made it back from her panel, and she's going to take over the reins again from Singapore. I'm jealous. This is Bloomberg.
Competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has 3 very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one-directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
that I... What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in Singapore. I'm back. We had a fantastic panel talking about green financing. We're joined by Noel Quinn and, of course, the chairman of Tata Sons, as well as the chief executive of Macquarie. Now let's get straight to the Bloomberg. First word news in London is Leanne Gerrans. Hi, Leanne.
Hi, Francine.
Boris Johnson is said to have told a private gathering of Conservative lawmakers that he had effectively driven the car into a ditch after 2 weeks of negative news stories for his party. Shortly after the meeting, the House of Commons voted to adopt the UK Prime Minister's plan to tighten rules on second jobs for politicians. Opposition parties abstained in the vote, calling for tougher reforms. Now, the ECB's vice president says inflation should slow next year, but not as quickly as expected a few months ago. Louis de Guindos told Bloomberg that easing price pressures would prove the current bout of inflation is transitory. He also says he expected the ECB to raise rates for at least a year.
We will see what happens over the next months with the evolution of the economy, the evolution of inflation. But my personal view is that it's going to be quite unlikely to have a lift off of rates in 2022.
Goldman Sachs is stepping up the expansion of its private banking team in London as it builds out its operations targeting the world's ultra-wealthy. The US bank has hired at least 9 private wealth advisors in the city this year from rivals including Barclays and Julius Baer. It's part of a strategy outlined by CEO David Solomon to make Goldman less reliant on trading revenue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, the strength of the global economy has been a key theme, of course, on the second day of the Bloomberg New Economy Forum here in Singapore. Earlier, we spoke exclusively with the HSBC Group Chief Executive, Noel Quinn, and we asked him about the U.S.-China relations and, of course, the inflation debate.
The world's economy is recovering. It's recovering well. There are tensions in the supply chain. We shouldn't be too surprised by that. We went into fast reverse. We're now going fast forward. There will be friction in the supply chain for a period of time. But take it as a positive that the world is recovering and economies are rebounding. If I then look at the concerns for the future, I am concerned about inflation because I think at the same time as the supply chain recovering, there are some new issues. Supply chains are repositioning, partly because of geopolitics, partly because of resilience considerations by governments. Oil prices are going to remain high for quite a while because there's constrained supply. And the investment cost of new sustainable infrastructure is going to have a premium in the near term.
But do you worry about shocks or do you worry about monetary mishap? What does it mean for a big bank?
I think controlling inflation is going to be a fine art as opposed to a science. And I think we're going to have to make careful judgment calls in the central banks over the next few weeks and months as to how they keep the balance between economic recovery and making sure inflation doesn't get out of control. And I think they'll do that through pulling back on QE and progressive, gradual increases in interest rates. And I think countries will move at different times on that, and that's okay. But it's going to be about balance.
We just heard from the former Treasury Secretary, Hank Paulson, also saying that it's almost impossible for the U.S. and China to decouple. Yeah. Like, how do you read the Chinese economy right now? And has HSBC rebuilt ties with them? Well,
listen, the Chinese economy has been big as a manufacturer of the world for many decades. It's also huge as a consumption market for the future. And I don't think the world can decouple from one of the biggest manufacturing nations of the world and what will be one of the biggest consumption markets in the world. So I really hope it doesn't decouple. Will there be differences? Differences in views on technology, differences in views on politics? Yes. But I think it's important that there is a level of connectivity between the world and Asia and between the US and China.
In general, for your wealth business, do you see, how many bumps along the road do you see? Do you see like a clean trajectory upwards in terms of how you build and
For
grow?
us, it's continuous investment. We already start with a very strong platform in Hong Kong. We're one of the biggest wealth managers in Hong Kong. We have on our balance sheet over 1.6 trillion of assets under management, wealth assets under management for our clients, whether it's in private banking, asset management, it's in our retail operations. Now, for me, it's about a continuous investment program. I guided the market that we were going to spend $6 billion over the next 3 to 5 years. $3.5 billion of that is building out our wealth business within Asia. And we're going to do that across all of Asia. I think there's wealth opportunities in Hong Kong still. China, definitely. Singapore, absolutely. And also India. Now, that will be a combination of organic investment, recruiting people. And as you've seen in Singapore, we bought a business, or are in the process of buying a business from AXA. Bring that business together with our insurance business, and we have a much more powerful wealth proposition here in Singapore. And I'm looking at 3 or 4 other opportunities like that as bolt-on acquisitions over the next few months across Asia.
Noel, have you spoken to Hong Kong authorities so that you don't have to do a quarantine next time you come back, as they rolled out the red carpet for...
I'm not planning a trip at the moment. I think it's important for Hong Kong to establish what they need to establish with China on reopening the Hong Kong-China border. I don't want to do anything that may jeopardize that. I would love to get back to Hong Kong as soon as I can, and when the authorities feel it's right for me to go back, I will do.
HSBC Group Chief Executive there, Noel Quinn, speaking to me a little bit earlier on. Of course, the focus was on controlling inflation. He said that controlling inflation is going to be a fine art as opposed to a science. Now, coming up, we'll be back live, of course, from here, Singapore, Bloomberg New Economy Forum, and we'll be discussing the surging COVID cases in Europe as the continent fights back. I'm looking forward to catching up with our chief economist, Tom Orlik. This is Bloomberg.
When you put the garbage inside, there's a little sensor that detects the garbage and speaks out. And this is one of the initiatives that we have created here. We, as the residents of this neighborhood, a bunch of neighbors that have come together to try to deal with the fact that our neighborhood is dirty. We want to make a difference. We want to have a clean streets that look nice and are nice to walk in.
בבקשה.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore at the Bloomberg New Economy Forum. Now, several European countries are stepping up their fight against COVID as cases are surging. Germany is urging more of its people to get vaccinated. Belgium is, of course, reimposing work from home. And last week, the Netherlands entered a new partial lockdown. Now, all of this raises a prospect of economic pain in Europe and possibly beyond. One person who's sounding rather more optimistic about recovery next year, though, is Bill Gates. We caught up with the Microsoft co-founder at the New Economy Forum here in Singapore.
Well, the vaccines are very good news, and the supply constraints will be largely solved as we get out into the middle of next year. And so we'll be limited by the logistics and the demand. The idea that economic activity will resume in full once you get to flu levels, it's very likely.
Let's get more now on what's going on at the New Economy Forum with Tom Orlik. Of course, he's our chief economist at Bloomberg Economics and author of China, the Bubble That Never Pops. He joins me here at the forum, both jet-lagged, but he makes a lot more sense than I do. Tom, when you look at, first of all, China, I mean, we talk about, inflation. We talk, of course, about, they're firing up the coal plants, and we'll get to that in a second. But does the economy really depend on whether they stick to their zero COVID tolerance policy or not?
So you mentioned the surge in COVID cases in Europe, Francine. China, the situation is different. They don't have many COVID cases, but because the government is pursuing this zero COVID strategy, even a few cases can bring an entire town, sometimes even an entire province, to a standstill. And what we're seeing as we approach the end of 2021 is that zero COVID strategy, combined with the energy shortages, combined with all the problems we're seeing at Evergrande and the real estate sector, that's really taking a toll on China's growth.
So what does it mean for the supply chain? We had talked about in the past that the fact that, we had a U.S. that was a little bit less friendly, certainly to multilateralism. A lot of the supply chains had already moved. Do they move further away from China? Can that even happen? Is it possible to move them away from China if they stick with this policy? Or this is, we have supply chain pains for quite some time to come?
So one of the big themes which people are talking about here at the New Economy Forum is supply chains and that interaction between supply chain snarl-ups and inflation. And some of the messages we've been hearing from the big bankers here, and today from some of the big corporates, we heard from Cargill, the agricultural giant, from Bayer, the life sciences giant. They're concerned that these supply chain snarl-ups, exacerbated by shortages of workers, they're not going to go away immediately. And what that could mean is that the problem we're seeing with high inflation right now, well, that could persist into 2022.
Great, Tom. Thank you so much. We'll come back to Tom Orlik, Bloomberg Economics chief economist, and we'll talk a little bit more about foreign relations. Who's your star speaker?
It's got to be Henry Kissinger.
Yeah, so we'll talk a little bit about what he said, U.S.-China foreign policy, and of course some of the pitfalls if we don't go into a more multilateral world. Now, coming up, we'll focus a lot more on foreign policy. One of the key themes here at the New Economy Forum is, of course, how the U.S. deals with China, whether there's this supremacy race to actually be the biggest and more powerful country, or whether there's going to be a lot more coordination between the two superpowers. This is Bloomberg.
esta operación definitiva para dar con la captura de este bandido la planeamos el 15 de octubre del año en curso. A las 8 de la noche en una guarnición de Bogotá nos reunimos con los oficiales de inteligencia de la policía, nos reunimos con los oficiales de planeamiento de operaciones especiales de las fuerzas militares y de la Policía Nacional, y es cuando se decide cambiar y darle otro salto a esta estrategia.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now. Into weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Europe grapples with its worsening winter COVID outbreak, while Germany pushes for more people to get vaccinated as Belgium reimposes work-from-home mandates. Amazon takes a Visa feud across the Atlantic after its UK card ban. The retail giant is now considering shifting its popular credit card to MasterCard in the US as well. And more top interviews right here from the Bloomberg New Economy Forum in Singapore. We'll bring you our conversations with Bayer's chief executive and Singapore's prime minister. So good morning, everyone. Good afternoon if you're watching from Asia. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore. Now, we had some wonderful conversations over the last couple of days. Of course, tensions over Taiwan, one of the critical points that we've been trying to figure out. They risk leading to miscalculations between the U.S. and China. At least that's according to Singapore's prime minister. Well, he spoke last night with our Bloomberg editor-in-chief, John Micklethwaite, here at the New Economy Forum in Singapore.
First, I would try to move on trade. You can't do an FTA, but you do want to move forward on trade, even despite the Democratic Party roots. Secondly, to develop the relationship with China, because if that relationship is sour, it's much harder for every other country in the region. Thirdly, don't stop with China. Also cultivate your other friends in the region and allies. And I think the second part Biden is trying to do. It's a long journey, but he's starting. The friends and allies, his approach is quite clear, and I think people do believe that. The last thing he can do is to ensure the president after 2024, whichever party of like mind.
That is sadly not in his...
It's not within his giving, but that is something which is very important. You must be able to look beyond, because America's interests extend well beyond 2024.
One last question on that is Taiwan. How much should we worry about what is going to happen there?
I think we should be concerned. I don't think it's going to war overnight, but this is a situation where you can have a mishap or a miscalculation and be in a very delicate situation. The leaders, the countries all say the right things. This virtual summit this morning, Joe Biden said, well, the U.S. will uphold its one China policy, and he also talked about the Taiwan Relations Act, which is long-standing. Xi Jinping said, we are not in a hurry to solve the cross-straits problem. Yes. It's a code word, but everybody knows what he means. And in Taiwan, Dr. Tsai Ing-wen says, we ask everybody to maintain the status quo. So everybody says the right thing. But if you look at what is happening, it is not a static situation. The U.S. has significantly increased the visibility, the level, and the intensity of engagements, diplomatic engagements, even military engagements with Taiwan. China has been testing Taiwan's air defenses. It flies aeroplanes into Taiwan's air defense identification zone almost daily. Doesn't go intrude into its sovereign airspace or its immediate airspace, but it's testing Taiwan's defenses and tightening up on international space, which was prepared to concede Taiwan even 5 or 7 years ago. And on the part of Taiwan, this DPP administration has disavowed the 92 consensus, which was to each his own interpretation, and says, no, that's not an acceptable formulation. And taking other steps, for example, printing on their passports in English, Taiwan passport. So all these moves raise suspicions and tensions and anxieties and make it more likely that a mishap or miscalculation can happen.
Well, that was Singapore's Prime Minister speaking there with our Editor-in-Chief, John Micklethwaite. Now, to talk more about, of course, foreign affairs and the impact this has on the economy, our Bloomberg Economics chief economist, he is Tom Orlik. Tom, you're a great student. Thank you so much for sticking around, first of all. But you're a great student, of course, of foreign affairs and how they relate into, economics on the long term. So we had this rapprochement. There was a lot of talk, especially here in Singapore, about the Xi Biden meeting lasting 30 minutes longer. So that meant they get along and maybe we could have progress. What does that mean for, first of all, the individual economies, but also the world economy as a whole?
So the story on US-China relations over the last 5 years, from the start of the Trump presidency, has been a story about risks and economic costs. Tariffs, sanctions, embargoes, all of this has hit individual companies, it's hit markets, and ultimately it's hit growth and jobs. The hope here, I think, in Singapore, in the wake of that Xi-Biden meeting, with Wang Qishan, China's vice president, speaking here at the NEF and committing to China's continued reform and opening, I think the hope is not that things are going to improve, the tensions are still there, but rather that some of the diplomatic guardrails have come back on and the relationship is now going to stabilize.
But so that means what, cooperation in certain fields, or does it actually mean that, for example, we could see a commitment on climate change or something more, for example, on the energy crisis?
So COP26, we already had that commitment from the US and China to do a little bit more together to address the world's biggest challenge, which is climate change. Can they go further than that? Can they do something on trade? Could we see tariffs start to come down? From where I'm sitting right now, that still looks like a stretch.
I need to talk about inflation and the Fed chair. So first of all, on inflation, where are we? Do you believe, what does a policy mistake look like? Do you believe actually central banks and saying, look, let's not call it transitory, but it will come down quite significantly? Or do you think that now is the right time for central banks to act?
So it's a complicated story on inflation, Francine. Certainly the transitory narrative that we heard over the summer, that was way too optimistic. US inflation now at 6.2%. 30-year high. We think it's going to climb higher into the end of the year. Looking into 2022, though, it's really difficult to see inflation sustained at the current high levels. The base effect is going to disappear. It's difficult to imagine energy prices continuing to add as much to consumer prices as they are right now. So I think we might be close to peak panic about inflation. And I think that means we might also be close to peak expectations in terms of how aggressive central banks are going to be on tightening.
Does it matter to the world economy? I know it matters to the traders. I know it matters especially to the bond traders, gilt traders. But does it matter to the world economy if we have, tapering or even a hike 3 months before than expected?
So the taper, we think, is going to run until June of 2022. The Fed's been pretty clear that they won't continue with asset purchases and hike interest rates at the same time. Those are kind of opposite forces. Buying assets adds stimulus, raising interest rates takes it away. So we don't think it's plausible to imagine a rate hike before the taper is completed. And we also don't think it's likely that the Fed will accelerate its taper. The risk, if they did so, would be a repeat of that taper tantrum, which did all of that damage back in 2013.
Tom, massive kudos, actually, because when I spoke to Andrew Bailey, when he disappointed the markets and the markets kind of fell out of bed because they didn't raise rates after talking up the markets, he said, but Bloomberg Economics got it right, so maybe more people should actually read your research. Is there a belief in the markets, and this is something that I explored with David Solomon yesterday, that they will always go up? So is there a disconnect between which we could see in central banks and we could see in the economy, and actually what markets are looking through?
kudos on that Bank of England call to my European team, Francine. I unfortunately take no responsibility for it. Well, it's very kind of you. So I think this is a challenging moment. We have really high asset prices, equity prices very elevated, property prices very elevated, commodity prices very elevated, and yet central banks now beginning to move towards a normalization of policy. Bank of England very likely to move on interest rates soon. The Fed very likely to move in the second half of 2022. And that combination of extremely elevated asset prices and the beginning of normalization in monetary policy in the US and elsewhere, clearly that's a challenging confluence of circumstances.
Tom, thank you so much. Tom Orlik there, Bloomberg Economics Chief Economist Tom Orlik joining me here in Singapore at the Bloomberg New Economy Forum. Now, coming up, we'll be speaking with the Chief Executive of Moe NSE, the conversation live from here. It's a conversation, of course, about gifting. China and the U.S. are two biggest markets. This is Bloomberg.
You should be thinking about formerly incarcerated people as representative of their families also and of their communities. These are human beings. They're not disposable items. They are not to be warehoused, locked away, out of sight, out of mind. And so I'm out here in the public because I am the conscience of those folks who, of America, I hope. I'm hoping to prick their conscience and know that I am just a symbol of a much greater problem.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore. Now, let's get to another one of our top interviews here at the New Economy Forum. We're actually discussing luxury drink sector. Well, key names of the industry have been posting bullish outlooks for the post-pandemic growth amid reopening and new consumer habits. Now, Moe NSE is the luxury drinks unit of LVMH. They make 28 million bottles of champagne, 28 million bottles, I'm going to say it again because I couldn't quite believe it, per year, and have been around since 1743. Now, it represented around 10% of the conglomerate's revenue in the first 9 months of 2021. Now, joining us now is Philippe Chaves. He is the Chief Executive Officer of Moe NSE. Philippe, thank you for joining us. I mean, we're going to have a great conversation on what people are drinking, what they're not, and their changing habits. But first, the number of bottles that you sold is absolutely incredible. How hard were you hit by the pandemic? Did people drink at home, or did they just drink less, full stop?
Well, we had a drop in last year in 2020, when all the restaurants and bars closed down. And so we were quite uncertain about what would happen. And then since the middle of last year, we saw, as bars were reopening, people coming back, as people were ordering from home, as our e-commerce activities were picking up. We saw people really coming back, and then this year has been very good. So we are really finishing, it looks like we're going to finish this year ahead of 2019.
if you look at the U.S. and China, these are your two biggest markets, and certainly China's gifting, but it's also the premium brands, especially from abroad, that they love. Has any of the consumption changed, and do you see that changing in the next 2 to 3 years?
So what we've seen in almost everywhere in the world has been an upgrading of the consumer in terms of his choices for alcohols and drinks. So we've seen people really coming back in consumption, moving up from that level to this level, and our brands have, of course, benefited from that. Now, between China and the US, it's a bit different. The US is a lot about cognac, of course, Hennessy, especially the more entry-level Hennessy, VS, and then about champagne, a lot of champagne in the US, and also about Chandon, and about our new Volcan Tequila, and our Glenmorangie whiskeys, and Ardbeg. And the China, conversely, is a lot about XO, Hennessy, which is the high-end Hennessy, VSOP also at that level, and then it's about whiskey, but not so much about champagne.
Have you been able to raise prices? Have you had to raise prices because of supply chain issues?
We have raised prices, but not because of supply chain issues. We raise every year our prices as to, we are selling limited products. We have limited quantities.
It doesn't impact demand. Does it impact demand?
No, it doesn't really. If you do it on a reasonable way, on a year-by-year basis, we have what we produce, whether it's champagne or cognac, is based on limited land, on limited number of grapes, and so it's every year there's a renewed effort to elevate further the quality, and that leads, of course, to higher cost as well, and that leads to higher prices. So.
Philippe, talk to me a little bit about COVID restrictions. So, a few of us had a drink of our choice at a bar, perhaps yesterday in Singapore, but actually they closed everything at 10:30, and that has been since the pandemic and since COVID. How much sales do you lose because of some of these restrictions? So not complete lockdowns, but just authorities being much more careful until, how long people drink.
Yeah, you had some losses be it in the US, be it in Europe. It was some losses, but it was in most cases overcompensated by the fact that people were consuming more at home. And when people consume at home, they tend to go more high-end again, because, of course, the bottle is cheaper in a liquor store than when you drink it in a bar. And so in the end, the overall effect has been rather positive for us.
When you look at climate change, I mean, you're really at the forefront because you're affected by grapes. We had a huge amount of grapes in France being affected by a pretty harsh winter last year. Is there anything that you can do to try and mitigate it?
Yeah, I mean, there are two aspects of climate change. One aspect is what do we do about our own influence on climate change. So we are working on our energy consumption. We are working on biodiversity. We are working on reducing packaging. We launched, for instance, with Rina, we launched a recyclable, very simple packaging on the Rina bottle. These are efforts on transportation, so moving away from airplanes, doing everything by ship, and even sometimes with sail ships. We have a project going on. So that's our own impact on what we do on our CO2 impact. On the other side, of course, in our vineyards, there is an impact of climate change. It is an impact on water, and there's an impact on temperature. And I just inaugurated a research center, which we opened up in Champagne, where we invest about 30 million euros for a big research centers, which has one of its main focuses will be what is the impact of climate change on our vineyards throughout the world, and how do we change some ways of doing so we progressively adapt to warmer climate and continue to make the best, the highest excellence in terms of winemaking in the world.
Are you also most expensive? I was going to actually ask you about taste, Philippe. I have so many questions. You're stuck here for the rest of the day. Have our tastes changed? So with time, do we like sweeter products? And do you do actually research on what people want to drink to make sure that it's calibrated to the sugar level that they want to drink?
No, I think the over the long term, has been rather going to a little bit less sugar. Okay. Over time, and so that is rather the trend. So
diet reasons or really taste?
I think both, probably. A Champagne Brut, like the Moët Chandon you showed earlier, doesn't have that much sugar. We also launched a spritz this year, Chandon Garden Spritz in many countries, and that has half the sugar of comparable products prior in the market. So sugar is rather going in our products on a downwards trend. Are tastes changing? Not really. I think, of course, more and more people are experimenting with higher-end champagnes and wines and are becoming more sophisticated in their tastes. And so we are benefiting from that, but that's more a kind of elevation of sophistication than anything else. So.
Philippe, thank you so much. So if I invite you over and give you Prosecco, you'll never come on Bloomberg again. Is that right? You don't even want to comment. Let's not go there. Let's talk about the markets. Philippe, thank you so much. Philippe Chaves there of NSC. Now let's get straight to your Bloomberg Business Flash. In London is Leanne Geertens. Hi, Leanne.
Hi, Francine. India's largest digital payments provider has lost more than a quarter of its value in its first day of trading, heading for one of the worst ever debuts by a major tech company. The 26% plunge in 197 communications operator of Paytm surprised even some skeptics who had questioned the company's valuation. The offer was India's biggest ever IPO. Now, Cisco has given a lackluster revenue forecast for the current period, blaming supply chain issues for component shortages. The world's biggest maker of computer networking equipment says it's expecting sales to increase by a maximum of 6.5%, half a percentage point below forecast. Cisco is trying to reduce its reliance on hardware sales and boost offerings of software and internet services instead. Nvidia has given an upbeat fourth quarter forecast fueled by its expansion into data center chips and other markets. The chip giant expects revenue to hit $7.4 billion during the period, more than $500 million above estimates. Nvidia has averaged about 97% revenue growth over the last 8 quarters, pushing its market cap way beyond Intel's. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, coming up, we'll be talking about Amazon's split from Visa over transaction fees. We'll be talking, of course, to our banking editor in London about that and, of course, the impact this has on some of these credit cards. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Singapore for the Bloomberg New Economy Forum. Now, simmering tensions have led Amazon to consider ditching Visa and shifting its co-branded credit card to MasterCard. Now, the news follows yesterday's story that the online giant is stopping Visa credit card payments in the UK from next year. Now, Amazon blames transaction fees, but Visa says they believe that they can rescue the relationship. Let's get more on this. To discuss the split is Bloomberg's Tom Metcalf. Tom, I'm not going to lie, a disclaimer. As soon as I read the news, I went into my wallet to check whether I had a Visa or a Visa or a MasterCard. But is this just a negotiating tactic by Amazon because Visa just can't let them go?
Yeah, exactly. And I think your experience is probably what a lot of people were doing yesterday. I mean, extraordinary. So anyone with a Visa credit card in the UK would potentially no longer be able to buy anything from Amazon from, I think, January the 19th. So, yeah, I was speaking to a few payment executives, and they are basically saying, if you take the cynical view, this may just be Amazon trying to, knock a few percentage points off the fees it pays to Visa. But there is kind of a bigger issue here. This has been a multi-year global fight between big retailers and folk like Visa and MasterCard. So the question is sort of how far does this go? Right now, the news is really in the UK. But what about in other markets? You're in Singapore right now, and I know Visa have introduced a surcharge there. Amazon have introduced a surcharge there. So does this start to spread to all the other markets, or will it stay, kind of within the UK?
I mean, the story, I have to say, is absolutely amazing. So let's say, Tom, that Amazon actually does split from Visa and the ban comes in. What would it mean for the payment processor as a whole? Do regulators step in because Amazon is so big? Like, where do we go from there?
Yeah, I mean, it's fascinating. It speaks to just, how dominant, say, a Visa is, that this would be a big issue, because I think Visa and MasterCard have about 98% of all processing at the moment. So if Amazon said, we are not accepting Visa credit cards, that would be, kind of really upend the ecosystem. Difficult to say, whether that will happen and what it would mean. But taking the UK example, Barclaycard, one of the biggest credit card providers out there, that's a Visa operation. So I'm sure what happened yesterday is folk at Barclaycard were pretty frantically calling up Visa and going, whoa, what can we do?
So Amazon, right, in general, believes that card fees should be getting lower with progress, not higher. Also because we have so many entrants that, have lower fees. Do they have a good case to lower the fees that credit cards charge in general?
Yeah, so tensions have definitely been rising between all retailers because they do feel Visa and MasterCard both are basically raising fees. So you've sort of seen that both in the UK but also in the US, particularly during the pandemic, where both Visa and MasterCard told retailers, look, we're going to raise the interchange fees. It's effectively what happens every time you swipe a card on stuff like e-commerce transactions. So that's really kind of sparked this latest, I guess, salvo in this long-running battle. And it's really who you speak to, right? Like Visa and MasterCard say, hey, we're, essential. We're just trying to make sure the business runs smoothly. And retailers are saying, you're gouging us. And it's going to be a big, long-running and painful battle, I'm sure.
All right, Tom, I know you'll completely stay on top of it, so I'm looking forward to reading all of your coverage and your team's coverage. Tom Metcalf there, Bloomberg News from our banking team. Now, in the meantime, this is what we're seeing in the markets. Let's have a look at the U.S., but also let's have a look at what Amazon, Visa, and NVIDIA is doing. Now, overall, it's true that Asian stocks were actually down. We saw a tumble in Chinese technology shares, but it's not really filtering through pre-market Visa, gaining some 0.4%. More Bloomberg next.
200 with 40% remaining.
101 years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels.
There are dozens of international companies in that airframe size who have realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with, through fuel cells.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
People feel the pinch of inflation and cost increases when they go to the store, when they go shopping and the like.
Some of the capabilities the team has built over the last several years, to use the ports example, operating 24/7 in the ports, that's something we've been doing as a retailer for quite a while now.
The idea that economic activity will resume in full once you get to flu levels, it's very likely.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kayleigh Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, November the 18th. Our top stories today. China takes a shot at rising oil prices. Crude falls after Beijing says it's releasing oil from its strategic reserves. Relations between the US and China take center stage. We'll have the latest from the Bloomberg New Economy Forum in Singapore. Plus, Bill Gates predicts COVID deaths could fall below seasonal flu levels next year. But there's a catch. We'll hear from the billionaire co-founder of Microsoft. That's coming up. Welcome to the program, everybody. I'm Anna Edwards, live in London with Tom Mackenzie here with me. Matt Miller, of course, in New York. Kayleigh Lines is off this week. And Matt, a host of topics then on the agenda, firmly on the agenda for us in Singapore at the New Economy Forum, from COVID recovery to the supply chain issues, all that still very much in the mix. For markets, though, a little bit of move to the downside in Asia, but things look brighter for the US.
Yeah, a little bit of a mix in markets as well. I noticed that people are pretty positive about the COVID situation at the BNF Forum. On the other hand, in Europe, the situation looks like it's deteriorating. In Asia, we have stocks that are down. The MSCI Asia Pacific, you can see, down about 1/3 of 1%. They're doing worse in Hong Kong than they are in Japan. That's because it's really the Chinese tech stocks that are weighing on the index, while in Japan, they're happy about an almost $500 billion stimulus package, and that has cut the losses that we saw earlier in the session. The yen right now is a little bit weaker against the dollar. You can buy more than 114 yen for the dollar. But the Bloomberg Dollar Index is actually coming off. We've seen the Bloomberg Dollar Index at an almost one-year high, rallying over the last couple of days. It's taking a little bit of a breather today. So up against the yen, but down against other major currencies. Take a look at what's going on in Europe, where we're at near record highs in Europe we are at near record highs, but I'm going to leave that for Tom McKenzie. S&P futures are up a little bit right now, about 0.25%, and European stocks, I think, are following along with that. The 10-year yield is up right now, 159.58, as investors feel comfortable enough to let go of the perceived safety of government bonds. Gold letting off a little bit, just 341 a troy ounce, and Bitcoin down about 1.1%. The elephant in the room on this screen, maybe I should say, is crude oil. I left it off because Tom McKenzie's going to hit on it, but this is one of, I think, the biggest issues in the markets today, Tom.
It's an absolutely fascinating topic as well. We'll look at the pricing action shortly, but the fact that this comes just a couple of days after that meeting between Presidents Biden and Xi, and now the Chinese are saying, yes, in fact, we are going to release some of our strategic reserves. Let's see how things are mapping out then across the European region. You were saying, Matt, that we were up. We've actually turned, we're now flat, but you're right, we are seeing gains of about 0.1%, but things have turned more negative now across the session here in Europe, weighing up, of course, those inflationary risks, but also, and you touched on this, that rapid rate of COVID infections, particularly countries like Germany, record rates, Belgium putting in new policies, mask mandates, work from home. The UK is lower on the back of basic resources and energy. The DAX had been up 0.3%. It's now lower in the red. The CAC 40 is just holding on to gains of 0.2%. You're seeing gains over in Spain of 0.2 as well. Let's switch it on and look at some of the cross assets then. You're talking about the dollar, the pound and sterling in focus. It's currently flat, just eking out further gains, but it's had its biggest session, longest run since about April, on these increasing bets that you will see a hike by the Bank of England in December. The inflationary picture here and the wage growth and jobs picture, that is positive and building in to that determination that you're going to see a hike in December. The European Stoxx 600, now the benchmark, just eking into the red. And in terms of that crude story, down 0.5%, so comfortably below the $80 a barrel. Again, on the back of this reserve release by the Chinese side. We'll see if Biden follows through, but that is a fascinating picture and dynamic in the energy space. Iron ore also lower, down 3%. Vale, one of the biggest producers, coming out saying they actually see a stable market next year.
Yeah, really interesting to see those moves then on oil prices and on iron ore, basic resources and energy, the biggest losing sectors here in the European market this Thursday. Let us take a moment to think about what lies ahead today then. And we have corporate earnings still to come. Alibaba's share price recovery faces a really big test today, with the company's third quarter earnings expected at just before 7 a.m. New York time. Turkey's central bank will announce its latest policy decision at 6 a.m. New York time. President Erdogan has made it clearer than ever, really, that he wants lower rates. He did that about this time yesterday. We got those red headlines across the Bloomberg on that very subject. The central bank is expected to deliver on lower rates today. And Biden will host the Mexican president and the Canadian prime minister at the White House. He's expected to hold a news conference after the meeting. North American trade, no doubt, in focus there. Now, getting back to one of our top stories, China is releasing some oil from its strategic oil reserves. That comes just days after Xi Jinping and President Biden met and discussed the merits of releasing oil during their virtual summit. Jack Fitzpatrick, Bloomberg government reporter, joins us now from Washington. Jack, so what is the significance then of China saying that they're going to be releasing these reserves now, just very much in the wake of that bilateral meeting between the two leaders?
Yeah, the significance of that is that it's a follow-through on a seemingly positive conversation that President Biden and President Xi had in their virtual summit on Monday. The Chinese officials have not yet given details on volume and timing of the release, and also we don't actually know for sure that this would not have happened without that conversation happening. But it is a follow-through from the Chinese side on a conversation that came up in that joint virtual summit on Monday. We also do have to see if the U.S. follows up on this. There's been some positive feedback on a strategic petroleum reserve from Chuck Schumer in the Senate, but House Majority Leader Steny Hoyer said he does not like that idea. So Democrats are not all entirely unanimously on board, and there may be some pushback. But as of now, this news is basically a positive follow-up on that discussion that happened between Presidents Biden and Xi on Monday.
Yeah, important context there, Jack. We also heard from former Treasury Secretary Hank Paulson, someone who's got deep experience of China, warning that the world is headed for a dangerous place if tensions between the US and China get worse. Paulson spoke at the Bloomberg New Economy Forum in Singapore.
We need much more certainty around how the U.S. and China are going to compete, where they're going to cooperate, and how they're going to manage conflict. Otherwise, the world is headed for a very dangerous place.
Jack, so that was the former Treasury Secretary Hank Paulson, again, someone who spent a lot of time on the ground in China over the years, is close to Wang Qishan as well. What do you make of this commentary? How aligned is Hank with those hawks now in Washington on the question of China?
That is basically a prevailing view here in Washington, really with members of both parties on Capitol Hill, certainly, that there's a lot of risk to the U.S.-China relationship if there's any sign of stability. I think further context on that, obviously, is the news this week that President Biden sort of slipped up and used the word independent when referring to Taiwan and had to walk that back and say that this was not a statement of U.S. policy regarding Taiwanese independence. So obviously on the sort of military front, there's plenty of risk, but also just the fact that the U.S. and China are two major economies, not necessarily always headed in the same direction. Any good news or even lack of news can be a positive thing in terms of U.S.-China relations, as long as it's not a slip-up on Taiwan or something along those lines like we've seen this week.
All right, Jack, thanks so much for joining us. Jack Fitzpatrick there of Bloomberg Government. Simmering tensions have led Amazon to consider ditching Visa worldwide, shifting its co-branded credit card to MasterCard. The news follows yesterday's story that the company is stopping Visa credit card payments in the UK from next year. Let's get more on this with Bloomberg's Tom Metcalf. So, Tom, is this just a negotiation tactic by Amazon? Do they just want Visa to lower their fees?
Yeah, I think that's probably a fair analysis. They're looking to sort of throw their weight around. You know, it's one of the few companies out there that can really go toe-to-toe with a company like Visa. So it'd be very interesting. These kind of things normally take months to sort of unravel, and Amazon is saying, hey, we're going to stop these Visa credit cards in the UK from January the 19th. So the clock is ticking to see if, maybe a resolution can be reached. And if not, it really, drastic changes in the UK payment landscape if it goes through.
Yeah, Tom, good morning. What does this tell us about how payments and the payments industry has evolved and is shifting, and the various methods of payment that we have as consumers now? Used to be just about credit cards online. Now there are a host of different options.
Yeah, exactly. I mean, you've got to look at it in the backdrop of the pandemic as well, and a lot of payments kind of shifting online even more than before. So someone like an Amazon has a huge heft in this space. And then, of course, there's an event yesterday where they said, this is absolutely fascinating, and folk like Visa and MasterCard are now in a sort of ecosystem where they are getting attacked from all ends. There's other options out there now with sort of direct-to-consumer type payment methods. So it's all up in the air, and it's just a fascinating time to be looking at it.
All right, Tom, thanks very much. Tom Metcalf there talking to us about the continuing developing Amazon story, dealing with its payment providers. Now, oil took a fresh hit, extending a retreat from a 7-year high in October. This as investors brace for the possibility of a coordinated release from strategic reserves in the U.S. and other nations, most importantly, including China. Let's get more with Will Kennedy, our executive editor for energy and commodities. So, Will, does it look like Biden and Xi are going to work together on this?
Well, it does, actually. So we reported yesterday that they were preparing, they had talked about a coordinated release during their virtual summit on Monday. They both agreed that they wanted to keep energy costs under control, and they both agreed that a release was a way of doing that. And then today, the Chinese government said that it is indeed preparing for such release. That will be seen, I think, as a win for Biden and his efforts to keep energy costs under control. And I think the next thing the market will be looking for is the announcement from the US that a release is coming there. Yes.
Will, does this put the nail in the coffin of Goldman's $90 call on Brent?
I wouldn't ever want to say what the price is going to be. You just don't know, Tom. But what I would say is I think it's noticeable that since the OPEC meeting at the beginning of the month, where Biden's calls for more oil was rebuffed, he's continually tried to talk the market lower. The administration has floated all sorts of actions, including a release, but also possible export restrictions, possible changes in refining mandates in the US. And it's working. It's kept a lid on prices. The market can't go higher because they know that these threats of stockpile releases and other actions are hanging over them. And it seems to have pretty much capped US oil prices at that $80 a barrel for the time being. Now, the problem that Biden is going to have is, some of these things you can only do once. The release you can't do too many times because your stockpiles be drained. So for the time being, it's working. Longer term, I think the outlook's a bit more uncertain because the balance of supply and demand looks very tight.
Sure, only a short-term solution. Will, thanks for joining us. Will Kennedy there, executive editor for Energy and Commodities, talking about the SPR, potential SPR release, coordinated SPR release. I think one of the most interesting market stories of the day, but there are so many interesting stories on the corporate level in the pre-market. Take a look at NVIDIA shares right now, up 6.25% in the pre-market. NVIDIA said yesterday after the close that they think $7.4 billion of revenue is possible because of data center sales. There's a boom in data center chips. The street was only looking for $6.9 billion, so that's better than anticipated. As a result, NVIDIA, Qualcomm, some of the other chip makers are doing quite well. Meanwhile, Cisco is doing poorly in the pre-market. It said that sales in the current quarter are going to be growing about 4.5% to 6.5%. So at most 6.5% because of supply chain constraints, and the street was looking for 7%. So Chuck Robbins, Cisco down 7% in the pre-market right now. And then finally, Lucid and Rivian. These stocks have been at the top of the volume list. I look at most U4 to see the pre-market movers, and every day on the top of the volume list, Lucid and Rivian, although Lucid trades 3 to 4 times as much as Rivian in the pre-market. Both are down a little bit today, but they have soared. I mean, this is an $85 billion company. Rivian's worth $130 billion. So it looks like traders are looking to take some profits, Anna.
Yeah, I was going to say we're not used to this kind of volatility with auto stocks. And then I thought, well, maybe these days we kind of are. Now, coming up on this program, Growing Inflation Risk, we'll discuss the investment outlook with Seema Shah, Principal Global Investors. Also get her take on that weakness in oil prices. We're seeing a lot of talk about SPR releases. It seems to be weighing on prices. And could COVID deaths fall below seasonal flu levels? More from our interview with Bill Gates ahead. This is Bloomberg.
Extra $1 trillion in spending, not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the president's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards and Tom McKenzie in London. Now, Ven Ram has written such a good piece on the MLive blog that it could put all of us out of a job. It's just so succinct and makes so much sense that you don't really need to discuss it any further if you're looking to invest in markets. Nonetheless, we'll do that. I'm assuming that you haven't read it. He points out that valuations are strong, and we're also looking at dividends that have really nowhere to go but downhill right now. Corporate profits are expected to continue growing. The only problem, the wrench really in the works is, or the biggest problem I should say, is the fact that central banks are going to have to address that kind of earnings inflation with rate increases. And we expect, or at least the market is pricing, more than 2 rate increases for the U.S. over the next year, more than 4 rate increases for the U.K. over the next year. That could bring the house of cards tumbling down. Ven joins us right now, currency and rate strategist from the MLive blog. So, Ven, what are the chances that we actually get rate increases from these central banks at such a precarious time for the global economy?
Morning, Matt. First of all, let me disabuse everyone of the notion that I'm putting anyone out of a job. That's not happening. But talking of central bank rate increases, I do think that that's definitely a prospect for next year. Definitely from the BOE, Bank of Canada, and the Fed. But I think where the markets are kind of going wrong is in kind of the over-exuberance in pricing in some of the markets, at least. In the US, they are factoring in 2 rate increases, which kind of squares with what James Bullard said earlier this week. But if you look at Europe, it's a completely different story. The markets are thinking the BOE is going to be raising rates like 100 plus basis points over the next 1 year. I don't think that's going to happen at all by any stretch of imagination, even under the most hawkish scenario. Likewise, they are factoring in about 10 basis points of rate increase for the ECB. But Christine Lagarde has already said that that's not going to happen, and that also flies in the face of sequencing. Sorry.
Ven, does this just reflect, good morning, by the way, does this just reflect a different relationship between central banks and markets in different parts of the world? Because certainly in the aftermath of the November confusion around the Bank of England, a lot of people have been writing about how maybe the Bank of England sees itself with a different role. Maybe you can apply this to other parts of Europe as well, giving market commentary, but not necessarily seeing its job as to steer the market. Whereas in the US, there is much more of a sense that the central bank should give a steer to the markets.
Absolutely, Anna. I think that a lot of that mispricing comes down to the communication issue. And as you know, Powell and his team teed up the taper so well that the markets, when they actually announced taper, the markets didn't really budge a whole lot. And that's why you see that pricing that is measured in the case of US. But in the case of UK and Europe, because of the communication issues that we have had, the markets don't really want to price the tail risk. But I do think that any tail risk is going to be on the dovish side, not on the hawkish side.
Ven, what does that mean then in terms of greater and more acute divergence between the central banks, particularly of the US and Europe, and how that reads across to the credit markets?
Well, I think that, you're going to see a lot of that spill over into the FX space already. And we are seeing that already. The euro has stumbled, like the euro index has stumbled like 5% in the past few months alone. And that's a pretty sharp drop in such a short span of time. And you see that rippling across through to the other currencies like the Swiss franc, which is appreciating contrary to what you would expect given the surge in yields. So I think that there's going to be a lot of spillover, whether it's into FX or into credit.
Ven, thanks so much. Thanks for your time. Ven Ram of the Bloomberg Markets Live team. Thanks to Ven for joining us. And you can get further market analysis. Check out MLIV Go on your terminal. This is Bloomberg.
Common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector. In Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, early edition. I'm Tom McKenzie alongside Anna Edwards here in London and Matt Miller in New York. Here is your first word news. Union workers at Deere have put an end to a month-long strike against the American farm machinery manufacturer. United Auto Workers members, they ratified a 6-year contract that will increase pay and retirement benefits. It was the first strike at Deere since 1986. In China, the debt-stricken real estate firm Evergrande plans to sell the rest of its stake in Hengteng Networks, an internet services company. That will bring in $273 million. Evergrande is trying to raise cash and make good on more than $300 billion in liabilities. The company is at the center of a debt crisis enveloping Chinese developers. And Goldman Sachs is ramping up operations in London to target the world's super rich. The firm has hired at least 9 private wealth advisors in the city this year from its rivals. Goldman is boosting its wealth management and consumer banking unit as part of a new strategy. The goal is to make the firm less reliant on trading revenue. We've got Seema Shah coming up when we're talking markets next. This is Bloomberg.
目前眼前状对我们军方来讲的话，我只跟委员报告，是我从军以来40多年以来看到真的是最严峻的时候。要翻台的话，他目前有这能力，都有的啊，但要看怎么一个结局。说我们不做任何挑衅啊，但是说把他激怒了，就跟我们人一样，你把我激怒了，我手上能力我也会发挥出来。所以2025是我们研判要全面啊，我们这样研判的。
China has, I've spoken with Xi about Taiwan. We agree we will abide by the Taiwan agreement. That's where we are. And we made it clear that I don't think he should be doing anything other than abiding by the agreement.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Tom McKenzie in London and Matt Miller in New York. Kaylee Lines is off this week. And Tom, things fairly range-bound when it comes to the European session today. We're pretty flat on the stock 600, either side of the flat line. The Markets Live team, though, putting out really interesting piece and chart and really interesting narrative around how stocks have so far enjoyed rather than feared the higher inflation story. So just as inflation has moved higher in recent weeks, we've seen stocks also moving higher. You just have to wonder how long that relationship lasts.
So the earnings story is obviously something that analysts are looking at as a supportive factor going into 2022 and the pricing power of some of these companies. But we saw the flip side of that with Target and Walmart, where their margins squeezed. They weren't wanting to pass on that pricing power. So we'll see. It was interesting that Citi now is aligned with Morgan Stanley in pricing in a more aggressive rate hike cycle, and whether that changes the dynamics in what is continuing to be a bull market, even as in today's session you've paired some of those earlier gains in Europe.
Does that change any of the TINA arguments? There is an alternative around stocks. Matt, US stocks, though, look as if they're pricing in something more to the upside at the start of trade. Europe here fairly flat, fairly dull at the overall level, but the US equity markets look set for some positivity.
Yeah, it does look like that, and I should point out, obviously the stock 600 is still near a record high, so it's doing pretty well. The S&P 500 near a record high as well, and you can see futures up about 0.25% right now, 46.98. Stock 600 is at 490 right now. The 10-year yield is coming up a little bit in terms of the yields. That means the price is down a little. Investors are willing to let go of that kind of protection, and maybe they're going to use the money to get into stocks. Maybe they're going to use the money to buy Bitcoin, although I should point out crypto is down today. They're definitely not using it to buy crude. You can see we continue to drop. NYMEX WTI down to 78 even off 36 cents a barrel, and the global benchmark Brent is also down today. The interesting stories, I think, are really on the corporate level. You've had a couple of profit warnings and a couple of forecast raises. NVIDIA, for example, says it can now make $7.4 billion in this quarter. Analysts were only looking for $6.9 billion. And the reason is this company, by the way, started out in chips used for video game consoles and now is doing chips for everything. But it's the data center growth that's helping it. As more and more people get into the cloud, more and more people are going to need chips or businesses are going to need chips to put them there, and NVIDIA is making them. So NVIDIA growing, it's the biggest chip maker in the world, by the way, by market cap, worth about $800 billion. Cisco, the router maker, is down right now. Chuck Robbins' firm said that they'll only boost revenue by 4.5% to 6.5%. Now, the street was looking for a 7% gain, but if they hit the low end of that range, it's going to be way off. As a result, the shares are down in pre-market trading. And then I showed you Lucid before. Rivian is also off just 3.5%. It's still amazing the market caps that these companies have. Lucid is worth $85 billion. They've never sold a car in public. Rivian has sold a couple hundred of its trucks, and it's worth $130 billion. So it's a Volkswagen-sized market cap, even though Volkswagen sells 10 million cars a year, and Rivian has sold like 250.
Yeah, really interesting. We were having these conversations around Tesla many years ago, weren't we? Now we're having them around some of these other newer names in the US. And interesting on NVIDIA, Matt, what you have to say there. I mean, they started out making chips for games. Now, if life is becoming a game, I'm talking about the metaverse or the omniverse, as NVIDIA talks about it, then maybe that plays well to their strengths. Let us get back to one of our top stories then, Matt, and that is around oil prices. For our radio listeners, I'll just describe what I'm looking at here in terms of this chart, this G chart that we have in the Bloomberg TV library. This is the extension of declines in oil prices. And we just have here a simple chart of WTI futures and Brent futures and how they've been generally moving to the downside over the last, 2 weeks, 3 weeks or so. And I just was interested to look at this because we haven't actually seen any releases from strategic petroleum reserves yet, but it is the conversation around that seems to be so powerful and putting some downward pressure on prices. Seema Shah, Chief Strategist at Principal Global Investors, joins us. And I wonder, Seema, how much you're thinking about a top in oil prices for the moment around these themes and whether that is playing into some of your thinking. Have we seen the worst, seen the highs for oil prices?
Hi, Anna. Well, look, I mean, when we've been thinking about oil prices, if you take the supply out for the time being, what we've been anticipating is you have that winter surge, and then, of course, that's putting up demand, and that's putting up oil prices. And then once you get into 2022 and you start to see a bit of a global growth slowdown, that's when you start to see prices move. Now, with the change in supply conditions, of course, that can create that additional volatility and hopefully put a bit of downward pressure on oil prices from here.
So, but only for the short term, right? And the question is, what does the kind of inflation that we've seen, and I'm sure most people expect to see it continue into next year, what does that mean for the Fed and for other central banks?
Yeah, that is the key question because, as we've been seeing with the inflation numbers moving up, and one of the reasons, of course, has been that energy price situation. Now, of course, we know that most of the central banks do look past some of those oil price rises, but we have to be considerate about demand destruction. What does that actually do? Is it really a tax on consumer spending, which, essentially, I think for Europe, it really is a bigger issue. But we are anticipating that central banks try to look through any of the oil price moves until it starts to hit inflation expectations. So actually, I don't think the dialogue changes too much from that perspective.
Does it change what do you think of the TINA proposition that Anna was talking about earlier? Is there any alternative to stocks in this market?
No, look, we believe that US equities, European equities is really your favorite place to be. Generally, risk assets should do well. And I think that we've been thinking about bond yields, we've been seeing them move up, but ultimately, as long as real yields are very depressed, and you still have strong growth, which we've seen from the latest very strong earnings season, actually, the dialogue for equities is actually still quite strong.
We've been talking about pricing power, Seema, and we talked to Hassam Asset Management earlier, Yogi Dewan. He was saying, look, I'm going to avoid companies like Walmart and Target, companies that absorb those costs and don't pass them on to consumers. Is that a strategy worth pursuing?
Oh, absolutely. You know, as we move into 2022, we've got to be very cognizant of all the supply chain issues. And I think what was interesting about Q3 was, as well as seeing really strong demand, you were hearing that a number of companies were worried about their margins. So from here on, it's really about picking those companies, which ones have got the deep pockets, the pricing power, and ability to absorb, but also hopefully to push it onto the consumers. So that, I think, will be a key decision going forward.
What do you do with technology in this environment?
We still do like technology, and I know that's a little bit surprising to many people as they see bond yields rise. But ultimately, when the economic environment is becoming a little bit more challenging, and we are thinking about people that have pricing power, companies that have pricing power, to us, it looks like mega cap technology, and also considering it as a structural trend going forward, we still think it's a good place to have some exposure within your portfolio.
So you like US equities. We keep hearing a lot of people talk about the attractions of European stocks. Maybe they're slightly less expensive compared to their US peers. But are you concerned around COVID? Is that going to be something of a theme through the winter? And do lower vaccination rates in certain parts of Europe start to become something that the markets move around?
I think it's something that we need to be considerate of. But to be honest, when we look at a lot of the European countries, and actually globally, aside from Asia at the moment, we are starting to look past COVID. We do feel like a lot of governments, although they're talking about lockdowns, we think they'll be very, very targeted. So we don't see too much of a downward pressure on growth from COVID going forward, unless, of course, we get some major shock from a variant. So to us, COVID is something we're hoping it's going to be a 2021 story, and it doesn't continue with us into 2022.
I was talking to one of our colleagues on the Markets Live blog earlier on, and he was saying his story for 2022 is all around food price inflation. We've seen quite a bit of that already. Is that something you would expect to really be to the fore in 2022?
It certainly could be. I mean, if we think about 2021, what is the focus for 2022? It's inflation overall. So I think from our perspective, a lot of it is going to be shelter inflation. You know, that is the underlying price pressures that are suggesting it's broader, more persistent. So we have to keep an eye on that. And of course, food price inflation is particularly important for emerging markets, and there is so much focus on that.
And in those emerging markets, it's only a short jump, of course, from food price inflation to political movements. Seema, thank you very much for joining us. Seema Shah of Principal Global Investors. Coming up on this program, Bill Gates predicts COVID deaths could fall below seasonal flu levels next year. We'll get the latest conversations around COVID. More from the billionaire co-founder of Microsoft speaking to us in Singapore. This is Bloomberg.
I was just finishing what you were saying, Tom.
Thank you.
November 3rd
You did
when the
your
decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now into weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
From New York City. We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie alongside Anna Edwards in London and Matt Miller in New York. It is the second day of the New Economy Forum, and COVID-19 remains a topic of concern as flare-ups around the world continue to impact lives and hamper economies. Bill Gates, founder of Microsoft and co-chair of the Bill and Melinda Gates Foundation, told Bloomberg COVID may get to flu levels by mid-2022.
Well, the vaccines are very good news, and the supply constraints will be largely solved as we get out into the middle of next year. And so we'll be limited by the logistics and the demand. In a lot of countries, it's not clear what the demand level will be. Ironically, in a country like many in sub-Saharan Africa, where the epidemic hasn't been as visible, your demand for the vaccine, it's challenging to generate that, but we'll do the best we can on that. The other thing that's pretty impressive is that, you know, Merck and now Pfizer have oral antivirals that the Merck drug, we've been able to reformulate to get it to be less than $8. And so we'll be able to have anyone whose age or medical condition makes them have significant risk immediately begin what's called presumptive treatment as soon as they test positive. So between natural immunity, vaccine immunity, and these oral treatments that can scale up in a way that the antibodies never did, you know, the death rate and the severe disease rates ought to be coming down pretty dramatically. And, you know, by next summer, getting to be, say, quite a bit lower than the average seasonal flu level is, assuming there's no surprise variants, which right now the evidence is that's not that likely, but it can never be ruled out.
What do you think, you just mentioned next summer, what do you think victory looks like in this? Is it effectively taking COVID back? You also mentioned the flu. Is it effectively making COVID a kind of flu-like disease? I know it is, but is that the kind of version of what victory is in your brain?
Yeah, things are fairly binary. I mean, if, you know, death rates from driving were 10 times what they are, people might think, wow, shall we do it or not? You know, flu is accepted. The, you know, average years of life lost for both flu and COVID is about 8 years because it's so prevalent in the elder versus the young. And we accept about a 60,000 average per year right there. Now, I happen to think as part of the tools innovation to avoid the next pandemic, we ought to go and eradicate flu as well, because its mutations are another source of a significant source of future pandemic risk. But yes, the idea that economic activity will resume in full once you get to flu levels, it's very likely. Now, you'll have some hot spots where you'll still have to have non-pharmaceutical interventions or, you know, huge incentives for people to get protected.
Bill Gates speaking there to our editor-in-chief, John Micklethwaite, at the Bloomberg New Economy Forum. And Matt, really interesting to think about the role that the pills are going to play here, that the oral treatments could play here. I spoke to a professor in this field just earlier on this morning, and she was saying just to be a little careful with some of the positive test results there. A lot of that's happening in the unvaccinated, and so does it really add to the arsenal for those who've already been vaccinated? But clearly, a lot could change next year.
Well, and I mean, you also have to catch the disease, get tested, realize that you're positive, and start the treatment fairly quickly. Within a week, you know, Bill Gates was talking about some sub-Saharan African countries where the pandemic hasn't gotten quite the publicity. In those countries, it's probably less likely that when you get flu-like symptoms, you're going to immediately test and get an oral treatment. But I do think it's interesting that he said we should consider eradicating the flu, trying to eradicate the flu, because that will be the source, is a likely source, a potential source of future pandemics. You know, we wouldn't even have thought that possible 2 years ago, to eradicate the flu. That was just a part of daily life that we accepted and killed so many tens of thousands of people every year. But now we're at in a place where we could.
It's really interesting, Tom, isn't it, when you think about the way that China is using still a zero-tolerance policy when it comes to COVID. You wonder how long that policy can last if we are going to enter into a phase, and we have in a lot of developed markets where other parts of the world are just kind of living with COVID.
The other issue for China is that they've been using Sinopharm and Sinovac, where we know the efficacy is much, much lower than Pfizer, Moderna, and even AstraZeneca as well. So when they get to open up the borders, what about the impact on a population that is largely unaffected by this pandemic? So that is a key question for the authorities in China.
Yeah, absolutely. Be sure to stay tuned to Bloomberg for the rest of this week. We'll be bringing you conversations from the Bloomberg New Economy Forum in Singapore. This is Bloomberg.
represent 5,500 forecourts, which is roughly 65% of all service stations in the UK. Of the ones that we were able to survey yesterday, roughly 1,500, 27% said they didn't have any fuel, 21% said that they had one fuel type or another, so that's either petrol or diesel, and 52% said that they were fully stocked. Northern Ireland, Wales, Scotland seems to be okay, but we still are seeing, like your reporters are seeing, some stock-outs at sites around London and the South East, I'm afraid.
When do you feel confident that this will 100% be in the rearview mirror?
Well, what we're hoping is those people that got fuel over the last few days obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks, to get it back to the sort of more normal running levels.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think inflation is getting to be a lot more structured for 2 or 3. Happens is when you start seeing sticker prices of 6 and 7%, that starts building inflationary expectations. And once inflationary expectations get anchored, then you get into the spiral. So I don't think it's such a temporary phenomenon.
I am concerned about inflation because I think at the same time as the supply chain recovering, there are some new issues. Supply chains are repositioning, partly because of geopolitics, partly because of resilience considerations by governments. Oil prices are going to remain high for quite a while.
When I step back and I think about my 40-year career, there have been periods of time
when greed has far outpaced fear, we are in one of those periods of time. Given that it feels like inflation's running above trend, chances are interest rates will move up. And if interest rates move up, that in and of itself will take some of the exuberance out of certain markets.
Few highlights there from the Bloomberg New Economy Forum in Singapore. Let's get over to Tom Keene right now, co-anchor of Bloomberg Surveillance. And Tom, you know, we've heard some, on the one hand, pretty optimistic outlook on the evolution of the pandemic from Bill Gates. On the other hand, we're seeing numbers that are just eye-popping in the heart of Europe with, you know, 1,000 new cases in Austria per 100,000 people. I'm almost afraid to go back.
Well, it's really changed. I mean, I noticed today some success, and I believe it was Lithuania and Estonia, Matt, but all in all, we're really focused on this. I think John Farrow has a really unique perspective because he has lived this moving around folks within quarantine, as does many of our team in Asia. But Matt, you're right, it doesn't go away. That's clearly what we're hearing from the medical crew at Johns Hopkins.
And Tom, I know that we've got Turkey in our sights today. We've got an interest rate decision in Turkey, and that's something that's on your mind this morning.
Well, it's an interest rate decision, but what it is here in the backdrop there is what we just heard from Singapore on inflation. This is really percolating, and the inflation chart is simple. It goes the opposite of devaluation to a much higher inflation. This is from an emerging market, Istanbul 5% level. And up we go, nearing 20%. The FT headlines today, just beneath 20%. I think our statistic is 17%. The answer is, it's a lot.
Yeah, I had to wonder whether investors need to carve out Turkey out of the EM basket or whether there is a read across to the broader space.
Yeah, this is a really, really important question. And I've always carved it out, Tom. I've been there a number of times. It's a two-tier fixed income economy, two parts, lira-based, dollar-based, et cetera. And you're right, there's always a discussion to carve it out of EM, and that now that'll be completely revisited.
Okay, Tom Keene, co-anchor of Bloomberg Surveillance, on the importance of that expected rate hike that we're looking at, rate cut, I should say, out of Turkey. That's one we're looking at coming up. Thank you very much indeed. Now, look, what else we are watching. I'm watching Alibaba. It is their quarterly results. We're going to be watching, of course, for things like the retail impact. We know the consumer in China is not back up to where it was pre-pandemic. But of course, it's all about regulations as well. So whatever the executives have to say on the regulatory front, I've been messaging the team at Alibaba. They tell me the earnings should be out in about 7 to 8 minutes time. So I'll be watching that and the read across to the broader tech sector in China. Matt.
Well, it's good to have an inside guy, Tom. I am watching, well, listen, tomorrow's going to be my last day here in New York for a few weeks. I go back to Berlin. I need to get all my stuff and bring it back. So there's two issues there. Number one, I'm making it Flannel Friday. I'm having everyone wear a flannel shirt tomorrow.
We got the memo. Not on air, though, I should point out.
Not on
I think
air,
I'd get in trouble for that.
But we've got a lot of people here working behind the scenes that, you know, are making the sausage, and they're going to be making the sausage in flannels tomorrow, I hope. Number two, I'm hoping to come back. I'm excited to come back, but I'm worried about the COVID situation in Europe. I'm going into basically the eye of the storm here. I remember at the end of this summer when I was in Spain with my lovely wife, and we were so concerned about our friends in New York because the case rate had jumped up to 300, 320, 340 per 100,000 in New York. Now we're looking at that in Germany. 392, so even more than that in Germany. 993 in Austria, or just about 1,000 in Austria. The situation in Europe has gotten a little bit out of control, and I'm concerned to head back into the eye of the storm, especially with my family.
Right, yeah, well, Germany now with record cases, but on the upside, if you're looking for the comforting messages, I saw that the German Vaccine Authority is now recommending boosters to everybody over the age of 18, so if you haven't had that yet, you can get in line for that one. Matt, I'm watching what's going on with interest rate decisions from Turkey. We've talked about this with Tom Keene, and despite the high inflation rate, there is an expectation that we will see a cut in interest rates, a third consecutive 150 basis points cut today, so we'll see if that comes through. But interesting, on that note, to think about the divergence between Turkey and other emerging markets, to Tom's point earlier on, to Tom McKenzie's point, we just saw Hungary raise its one-week deposit rate. And if you add up all that Hungary has done this week, they delivered a big weekly rate hike in back-to-back steps, that putting upward pressure on their currency. So the divergence across emerging markets, certainly something that we are watching very, very closely. Now, more Bloomberg surveillance is ahead. We'll be hearing from Steve Viting, who is from Citi, and Megan Green of the Harvard Kennedy School. All of those conversations coming up, plus plenty more from the Bloomberg New Economy Forum live in Singapore today and into tomorrow. This is Bloomberg. When your shares are down 20%, it's going to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Central banks should be independent.
It's going to be very difficult for the Fed to backtrack on the taper process.
The training wheels are off, so to speak.
The market's underestimating the extent of fiscal drag that we're going to face next year.
One of the features of an economy that gets too hot is it does blow itself out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Imminent is before Thanksgiving now. Just to clear that up. From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market up 1/3 of 1% on the S&P. TK, it's before Thanksgiving. We might hear that Fed share pick.
You know, the inflation debate is really heating up, and frankly, intellectually, that's so much more interesting than trying to figure out what imminent means. The only thing I know about Thanksgiving is I turned to Mrs. Keenan and I said, no restaurant is what we're doing.
TK's not cooking this year.
It's imminent that I'll be in a restaurant early in the afternoon of Thanksgiving.
Let's talk about what's cooking in this market, Tom.
Yes.
JP Morgan coming out with their Fed call. Mike Feroli going with September of next year now.
Yeah.
And looking across the other side of the Atlantic, abandoning bets on a 10 basis point hike from the ECB in 2022. That's the market story just dropping moments ago, Tom.
Right, and the shift out is there, and I really want to emphasize we've got lots to talk about, a fabulous set of conversations today. John, the inflation debate is really, really heated up. Paul Krugman may be pushing against the worry, and there's a lot of people lining up saying this Fed policy is constructed wrong. I missed this a couple days ago, John. You didn't tell me about it. Willem Bouter's essay in the FT was a tour de force.
I missed that too.
Absolutely superb. Thank you, Mohammed Al-Arian, for bringing it to my attention. But folks, you need to understand the intellectuals are out front thinking about your higher inflation.
Lisa, setting us up potentially for some central bank divergence.
One of the key issues to me is what if we reach the new normal? And it seems like the new normal in the United States is going to be a lot sooner than in the European region. And this really underpins the euro. Yesterday, right, we saw it fall to the lowest, going back to in 18 months, I believe, 19 months. I mean, honestly, this has been a pretty significant move at a time when otherwise there's been pretty much stasis in
Talking
the
about
markets.
a move, Lisa, just quickly, 77.89 on crude. We're down 0.6%. We talked yesterday about that report in the South China Morning Post that China and the United States may get together and get rid of some of those reserves, those oil reserves. And China is working on just that.
Yeah, the idea that they're actually following through and saying they're preparing a release, raising a question in my mind, John. When do we hear from the U.S. administration that they're doing the same?
Watch this space. Crude lower, equities positive, up 14 on the S&P, advancing around about 1/3%. Equities with a little bit of a lift. Yields basically unchanged on 10s at 159.58, in and around 160. And in the commodity market, there it is, TK, 77 handle on WTI,
Yeah.
$77 and about 80 cents.
It's pullback. We see it across the commodity index, and you watch the sauce. It is a pullback and open to debate. Again, I would suggest those looking for higher prices, John, are looking at global demand, particularly Pacific Rim demand, to be buoyant, as they say.
Turning things around in the FX market, euro dollar, Lisa, 113.38. Just a slightly stronger euro this Thursday morning.
But still the policy divergence very much underpinning that story, even if today you're seeing a little bit of a rebound. Okay, today what I'm watching is when have we reached the new normal? How do we know? And I'm looking at this because we're going to get initial jobless claims at 8:30 a.m. The expectation is for a new post-pandemic low of about 260,000. We're getting there. We're getting to where we were before the pandemic, and this really bleeds into the unemployment rate at 4.5%. That's getting down to where we were pre-pandemic at 3.5%. When have we reached the new normal? When can the Fed have some conviction about what we're seeing as being a longer lasting trend? At 9:30 a.m., we hear hearings. The Comptroller of Currency Designate, Saleh Omarova, is going to be testifying before the Senate Banking Committee. A Cornell law professor, a firebrand of a speaker. Many people have accused her of having rather radical ideas about the industry. The question is, can she get full Democratic support to get through? She just needs one person to defect, and she will not be the head of the OCC. And today, it's another fire hose of Fed speak. Honestly, what are we hearing from all of these Fed speakers? We just keep a roster going. Raphael Bostic, John Williams, Charlie Evans, Mary Daly. Yesterday, it was all about Treasury market dysfunction. Today, will we hear anything about the pre-Thanksgiving announcement? Maybe. I mean, honestly, you were saying that, imminent means before Thanksgiving, but you can add a maybe to that, John.
We can hardly wait. Lisa, thank you very much. Let's bring in Steve Whiting of Citi, shall we? Heads up the economic coverage and the equity coverage as well, the chief investment strategist. Steve, let's start with this equity market. You've pulled back on exposure a little bit. Why is that, Steve?
Well, it's been an evolution. We've obviously had a really powerful bull market response, unusual for a recession period in 2020. And one of the things that we put into our note yesterday is that if you just took a look at narrow groups like leisure, hospitality, and cruise lines, the return's been 180%. Now, these are not really powerful long-term growth industries. They've made a full circle. So what we want to do is to move into industries and components of the equity market that have long-term dividend income, that have outperformance of the economy, that are safer in many respects. So our overall equity overweight is about 6 percentage points. Our risk asset peak was about 11% overweight earlier this year.
Steve Whiting, can the public hide in equities if they presume higher inflation? Are you forced to equities because nominal up, inflation up, it's the only game in town?
You know, that's a little too easy, right? Again, if we had markets price inflation as a very long-term problem, and believe me, with yields here, with valuations across markets, they're really not priced as if inflation will be this high permanently. So if that were the case, we probably would be disrupting the recovery. We would have problems, right? We would have to assume a very different outlook for the Fed and where the economy could go. So it's not as simple as that. But yes, in some ways it is, because companies are paid in nominal dollars. Central banks don't print software or oil or real estate, all of these things. The real economy is where we have to invest when we're in an environment of financial repression where real yields are negative.
So, Stephen, if you're reducing then your overweight in equities, which many people say is the only game in town, where do you put that money?
Well, I would just say that there are some components of fixed income where we're not trying to increase our wealth, right? They're in a total portfolio context, right? We've shifted a little bit of money to medium duration investment grade securities, right? On the notion that as we get somewhat higher yields, we can shift further out the yield curve. And this is solely for protection from the downside. This is not, again, to make wealth go up that much. But there's a 6 percentage point overweight in equities is a very positive exposure. We would expect probably high single digit total returns in equity markets over the course of next year. I think that the chance that we actually get that we actually deliver that will be much higher in dividend growth stocks, for example, in the healthcare sector, in the staples sector that had to absorb this terrible inflation in the past year, right? Those have deeply underperformed. They are more stable industries, and they're not quite so hit by cyclical risk when we do have it.
Stephen, embedded in this call is the idea that bonds can still offer that hedge against equity risk, even at these low yields, and even if that risk is inflation. Is that accurate, that bonds can still offer that hedge despite this backdrop that is quite bearish, ostensibly, for bonds?
Much less. But if you think about it, right, in the case of these very low-risk securities, when you have drawdowns in equities, they may not go up rapidly in price. We may not price a big Fed easing cycle, right, and a lot of appreciation. But with these lower duration securities, they're already dialing down portfolio volatility. We don't tell people to have a portfolio filled with that, right? But having some of that in a portfolio can optimize the level of volatility you want in the portfolio. Even if they're hit by inflation, the level at which they go down is much less. But again, this is, still a positive outlook. We are looking for growth in the coming year. I expect 3.5% U.S. GDP growth. I haven't had to cut that because we didn't have so wildly ambitious forecasts. And I think that headline inflation is going to be down to 3% next year. Now, from the perspective of last year, that might sound high. From the perspective of this year, that sounds good.
Steve, it sounds good compared to the 6 handle we saw last week. Bear with me a second. I want to jump in and talk about dollar lira. A move of about 0.9%, a choppy session for this currency pair. Tom, a 100 basis point cut from the central bank of Turkey. Widely expected, but there it is. And then this line from the Turkish central bank to assess ending rate cuts in December. But it's another 100 basis point move, Tom, from Turkey.
This is important, and with Steve Whiting here, and privileged, Steve, to have you here with the Citigroup International Reach. Do you look at Turkey as idiosyncratic, or can it lead a la Stan Fisher out to what we enjoyed in the 90s?
We think it's probably idiosyncratic. Emerging market central banks are generally following orthodox monetary policy. You could see Brazil, for example, with its rate hikes. And fighting inflation. This sort of environment, I think in terms of global macro policy, is probably going to leave us with markets that still view a few outliers as probably not something that is going to create a great problem across markets. The fact that we're early in a Fed tightening cycle, I guess we'll call it that at this point, is still that kind of a risk that we have to assess, that there'll be wider problems as there was in this 2013 through 2016 period, that taper tantrum and early Fed tightening period. But this time around, the U.S. dollar is at a much higher level. The oil price, for example, which collapsed 66% in 2014 and 2015, we think that the whole picture is somewhat less vulnerable for EM.
I like how we're calling it a tightening cycle already, Steve. It's good to catch up, sir, as always. Steve Whiting there of Citi. Dollar lira, 10.77, Lisa. A weaker Turkish lira, a 100 basis point cut.
Well, Erdogan is fighting interest rates. He thinks that paying more interest is bad, so he's lowering interest rates, and that'll bring down inflation, except that it's not. And that's what we're seeing in the lira weakening yet again, John.
The next inflation print, Tom, December 3rd. In at around 20% at the moment, and could well go higher.
John, I'm going to disagree with that. For the President of the United States, the next inflation print is this weekend when the public goes out there and enjoys it, including the price of a turkey. John, this is real and tangible. I got to be honest, I am loving this intellectual debate, not revisiting the 70s, but revisiting what are we going to see in 2020. John, is the market moving towards pre-Misra? That's what I want to know. Are we shifting to
Mike Ferroli is not. Mike Ferroli is not. Mike Ferroli at JP Morgan going with September of next year, pre-Misra, waiting until December 2023 for that first rate hike. Your equity market up a third of 1% on the S&P, advancing 13 points. Alongside Tom Keene and Elisa Abramovich, I'm Jonathan Ferro. For our audience worldwide from New York City, this is Bloomberg.
With the Fast Food News, I'm Rishka Gupta. China is releasing some oil from its strategic oil reserves. That comes just days after Xi Jinping and President Biden discussed the merits of releasing oil during their virtual summit. Both the US and China share concerns over the high price of oil and inflation. Economists at JP Morgan now expect the Fed to raise interest rates next September. In a new outlook, the bank says that by the middle of next year, the Fed's goal of full employment will be satisfied. JP Morgan is the latest Wall Street bank to abandon an earlier forecast that the Fed would stay on hold through next year. Billionaire Bill Gates says that COVID deaths and infection rates may dip below seasonal flu levels by the middle of next year, but the founder of Microsoft says that's assuming new dangerous variants don't emerge in the meantime. Gates spoke today at the Bloomberg New Economy Forum in Singapore. And union workers at Deere have put an end to a month-long strike against the American farm machinery manufacturer. United Auto Workers members ratified a 6-year contract that will increase pay and retirement benefits. It was the first strike at Deere since 1986. Amazon is escalating its dispute with Visa. The world's largest online retailer may shift its popular co-branded credit card to MasterCard. Amazon has already decided to ban Visa's cards in the UK next year because of rising fees. Bloomberg's learned the company is ramping up the pressure as a way to secure better terms from Visa. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Certainty around how the U.S. and China are going to compete, where they're going to cooperate, and how they're going to manage conflict. Otherwise, the world is headed for a very dangerous place.
Hank Paulson there, the former U.S. Treasury Secretary at the New Economy Forum in Singapore. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market shaping up as follows. Futures positive 15. We advance around about 1/3 of 1%. Yields are unchanged on 10s at 159.41. But the main event in the FX market is dollar lira. 1097.65 is the high of the session. Right now on dollar lira, 1083.82 off the back of a 100 basis point cut. And Tom, maybe the most hawkish thing I've heard from the Central Bank of Turkey in quite a while. They'll study ending these rate cuts in December.
They got to get to December. And I think here the dynamic, folks, for those confused on radio by the chart, it was I'm going to call it a modest strengthening of lira and then the disappointment of this announcement, John. And you wonder what they want. Well, what they want is for Mr. Erdogan to have an understanding of Econ 101. That's really what's missing.
It's a little bit counterintuitive right now. And Lisa, for those of us wondering out there, if I was being sarcastic, I was. It is the most hawkish thing I've heard in quite a while, Lisa, but that's all relative, isn't it?
The idea here that we're talking about a bank that just dismisses the fundamental economic principle that tightening rates, that tightening policy, raising rates is what's going to lead to lower inflation. They just outright reject that.
1085, Tom. 1085.
1085 on lira, and we've got to watch it. That's a moving target this morning. Before we get to Jack Fitzpatrick, I just want to take a personal note that as Henry Paulson visits Michael Bloomberg in the New Economy Forum in Singapore, he does as the gentleman who has single-handedly tried to save the wildlife and birds of all of Southeast Asia. Hank Paulson single-handedly saved the 6-foot-tall Philippine eagle. He has spent millions on this. He's absolutely unique in philanthropy and is just a guidepost of doing it year after year after year. It's just amazing to see him in Singapore, where he's spoken many times on wildlife and the forests of the Southeast Asia. With that, to Jack Fitzpatrick and Bloomberg government in Washington. Jack, what's the inflation debate in Washington? We're having a fancy pants debate here on economics, and we're arguing about math and theory. Nobody cares in Washington. What's the inflation debate right now?
The inflation debate in Congress is pretty repetitive because they've kind of gone in circles around what exactly the effect of future bills would be. This reconciliation bill for the Democrats are trying to pass, and they're waiting on a score to see how much of the spending would be front-loaded and if it really would have that effect. More on the campaign trail going to 2022, it's looking to Thanksgiving, and it's considered definitely a political weakness for the president and for Democrats heading toward the midterms. The cost of a Thanksgiving dinner, the cost of gas prices that the president has talked about. But really, there's not a debate that has gotten into the nuances of it so much on Capitol Hill as it's just recognized as a weakness and a risk for Democrats right now.
It's a risk. Why isn't it a risk for Republicans? I don't get that. Republicans are driving F-150 pickup trucks. They're not EV like the one Matt Miller's going to buy. Why is this a Democratic issue? It's everybody's issue.
That's true. It's everybody's issue. But for one, and Democrats benefited from this when President Trump was in office, if something bad happens, a lot of it's going to be on the president's shoulders. Two, there may be a little bit of a bias toward attributing major things to something that the president can have control of. We may overstate at times the actual inflationary effect of this reconciliation bill compared to supply chain issues, compared to the global economy. But this is something they're working on in Washington, and if it has an inflationary effect, this spending and tax bill coming up, then that's what a lot of lawmakers are going to talk about. So it's a political issue more than the real nuances of exactly how it works.
Yeah, Jack, nuance doesn't really work in the U.S. political sphere. That is one thing that we learn over and over again, which is why probably this administration has harped so significantly on the oil price and on potentially releasing some of the reserves that the U.S. has. Are we expecting some sort of imminent announcement, I say before perhaps Thanksgiving, with respect to the release of some of the SPR after China's move to do the same?
The timing on a U.S. move on that is a little tough to pin down. I'm not sure we could say imminent right now. The latest developments on that is there was a little bit of pushback from House Majority Leader Steny Hoyer saying he doesn't quite like the idea of a strategic petroleum reserve release. So there's not entire unanimity among Democrats on the idea for this, but obviously it was something that came up in the conversation between Presidents Biden and Xi, and is something that the president has talked about. So I'm not sure we can say imminent just yet, but it's certainly on the radar for the president.
Meanwhile, Jack, aren't Congress members on vacation again? Isn't there a recess again?
There is supposed to be next week. There's so much piling up on Capitol Hill that it's not entirely clear if everybody's going to leave. The Senate is moving to consideration of the defense authorization bill that they really need to have enacted by the end of the year. So there may be some work on that, and they may stay over. And also the question of waiting on the score for the reconciliation bill, which might take until late Friday. It's not impossible that they could actually stay Saturday and vote in the House on that, or even stay next week. So believe it or not, they're not entirely concerned with their travel schedules and potential vacations. There might be some significant work beyond that. It depends on the schedule over the next couple days.
Jack, thank you. Jack Fitzpatrick down in D.C. on the latest. Tom, we're still struggling to get away from this pandemic. And I think of Europe right now, some European countries pushing people to work from home, and thinking about what next in the United States as we start to push these boosters maybe onto more of the population.
19, 20 months on, the Commerce Bank publishing their update today and noticing some of the Baltic states doing a little bit better. And it's really every nation for itself, don't you think, John, particularly on the continent?
At the moment, Tom, yes, but you can start to see a theme emerging here. More and more countries getting behind more restrictions, Lisa. Certainly not the draconian lockdowns that we saw in spring of 2020. but certainly starting to see a whole lot more getting deeper into winter.
Yeah, and it's being led both by the public and the private sector. The idea that businesses are getting harsher and basically feeling like they've got a carte blanche to do so based on the legal precedent and based on government policies. This is sort of compelling to me. And you asked a question yesterday, John. Are they working? Are some of these restrictive policies and mandates working? And a lot of people seem to be saying, yes, more people are getting vaccinated. But I do wonder long term.
Are the vaccines working in the way they hope for as well? We need to talk about that.
You getting
with
a booster?
Johns Hopkins a little bit later. I will get the booster. Here in New York City, they're looking to push it out to more and more people. Why not?
Yeah, me too. I mean, honestly, I don't want to get sick.
Equity futures up 16. I'm
You're
pleased
like,
we had
great.
that discussion.
Are you though?
A third of 1%.
I took a week off after my booster.
TK had his booster.
Yeah, I took a week off.
I'll have my week off next week. 159.24 on 10s. Unless, of course, we get a brand new chairman of the Federal Reserve, in which
Really?
case I'll be in.
Really?
I'll come in just for you to talk about it.
I can't
so
wait.
important.
I'm
You'd
going to call
miss me.
Joe up and say, wait 2 days into Pharaoh's vacation.
From New York City.
You will.
This is Bloomberg.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm on.
I noticed that.
Do you think I need a lift? Is it time
What
that
did
I
he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
I think what we've seen during this period of time is that communicating via video is not